In New York City on this Monday morning. Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Brad Smith alongside Brian Saze this morning. Let's get to the three things that you need to know today.
All right, stock futures are mixed as the market is set to kick off a holiday-shortened trading week. Market action will likely be muted, but many are hopeful we could see a so-called Santa Claus rally push the markets higher to end the year. Stocks are coming off a losing week, dragged lower by hawkish signals from the Federal Reserve. Central bankers now seeing a slower pace of rate cuts for 2025 and that higher for longer approach hanging over the final trading days of the year.
Plus, Nordstrom is going private, announcing that it will be acquired by the Nordstrom family and Liverpool in an all-cash transaction. This is valued at $6.25 billion on an enterprise basis. Following the close of the transaction, the Nordstrom family will have a majority ownership stake in the company. Nordstrom shareholders will get $24.25 cash for each share that they own.
Got a sweet sweater over at Nordstrom for the holidays. And of course, Nvidia is not having a cheerful month. Shares down nearly 3% in December. We saw shares peak for the year back in November. Nvidia has fallen behind the broader markets in the past month. Some analysts considering the stock's valuation may be too high. Some predicting slowing growth for the chip giant in 2025 as well. Taking a look at stock futures on this holiday shortened trading week, a little bit of mixed across the board, but I got to call out, shout out for the Dow. Dow futures down more than 200 points, seeing some of that selling pressure that we saw last week after the Fed decision perhaps resume to kick off this holiday shortened trading week. The Nasdaq in the green, though, continuing its positive vibes. Let's take a look at the bond market here, too. That's coming into focus as well after that latest Fed decision, seeing the 10-year at about 4.55%, not too far away from that 5% mark, which a lot of the bulls or the bears on the street are concerned could send markets a little bit lower.
You know, we're also taking a look at Bitcoin here this morning. It's trading to the downside after posting its first down week since President-elect Trump won the general election. And also taking a look at the Mag 7, you're seeing most of those names right now in the green. Microsoft, one of the lone pre-market laggards right now. It's down by about 0.1%. And there you're taking a look at, of course, the rest of the roundup of the Mag 7 stocks here on your name: Alphabet, Meta, and Amazon on your screen.
And you're welcome in advance for this one. I know everybody loves a good calendar on a holiday shortened trading week. As we mentioned, it's a short week due to the Christmas holiday. Here's a bit of what to expect. We get consumer confidence out at 10 a.m. Eastern time today. Markets close at 1 p.m. tomorrow on Christmas Eve. The bond market closes at 2. All markets are closed on Christmas Day. We'll be back here Thursday and Friday with some fresh data out. And an important note, tomorrow could be the start of the so-called Santa Claus rally, the time when we typically see gains in the last 5 trading sessions of December through the first 2 trading days of January.
All right, so you don't need a Dow 45,000 hat. You just need a red hat with a
I just need a hat. I need a beard, Brad. I need a beard.
We can work on that.
We can work on that. I can't grow a beard. I've tried to grow a beard.
Are we challenging each other to that in
don't challenge me to a
2025?
beard, because I will take it to an extreme knowing myself. I'll grow a beard and then I'll kick off our network.
All right, you'll see Pennsylvania Brad come back. You'll see Long Island Saws come out too here. Now let's toss to some news out this morning here. Nordstrom announcing it's going private here. The Nordstrom family and Mexican retailer Liverpool will acquire all outstanding common shares in an all-cash transaction valued at $6.25 billion after the transaction, expected to close in the first half of 2025. The Nordstrom family will also have a majority ownership stake in the company. You're taking a look at shares here pre-market. They're down by about 1.4%, and we should note that this is essentially about a 42% premium to the stock price, not too far off from the level that we'd seen in March 18th of 2024, which they had kind of pinned this back to at that point. So ultimately, taking a look at shares here pre-market, this is something that's been rattling about in the markets for almost 7 years now.
Yeah.
It's been crazy to watch.
This is a little bit personal for me, because Nordstrom was one of the first retail companies that I covered as a young analyst. And if I learned anything from getting to know Eric Nordstrom and a little bit of the Nordstrom family more broadly, their family founded this company. 1901, very passionate about this brand, passionate about bringing technology into the store, passionate about doing other things other retailers aren't. So very important there to see inside of this deal, the Nordstrom family will have a stake. They will keep a stake in the company, which will help them, I guess, to continue that vision or that founding vision that their family put in the ground. Secondarily, the trader way to think about it is, what does this do and what does this mean for Macy's? This Macy's got received an offer about 12 months ago to take them private. They've been under activist pressure. Now you have certainty of value in this Nordstrom deal, Brad, for a major department store chain. And I think this puts Macy's back on the block here. What do they do? How do they extract value? Because you've seen Macy's shares under a good bit of pressure here. And I think that market has not really bought onto this notion that Macy's store closures and restructuring will be the path to drive enhanced shareholder value over the next decade.
Yeah, and it's a question about what the consumer in the near term, how they decide to pull back or continue to maintain, if you're on the upper end of that luxury spending, maintain the discretionary spend that you decide to still engage with a brand like Bloomingdale's underneath of Macy's or a Nordstrom, or for me, I'm just going straight to Nordstrom Rack at this point. So I'm not in quite that luxury end, but I'm looking to see how I can get there.
The prices are out of control this season, Brad.
It's
we could spend about a good hour on this. I went in for some Tom Ford cologne at Bloomingdale's. This stuff is now over $4 a bottle. And it's not the big bottle, Brad. It's like that baby bottle.
Yeah.
Hey, what are we doing here? What is going on?
You got expensive taste.
No, I don't, but I thought it used to be like $200. Now it's like double.
It did used to be $200.
It's hyper waffled, Brad.
We have the same one. I think it's just at higher highs at this point. All right, well, over the weekend, President-elect Trump addressed Elon Musk's growing political influence, dismissing the notion that Trump had ceded the presidency to the billionaire. The comments came after a whirlwind week in Washington, where Musk helped derail a bipartisan plan to fund the government. Here to discuss is E.J. Dionne Jr., senior fellow at the Brookings Institution and a Washington Post columnist. EJ, always a pleasure to get some of your time here. What is the political influence of Elon Musk shaping up to be even ahead of the inauguration?
First of all, happy holidays, Brad and Brian. And I always learn new things on this show. I love the idea of a Santa Claus rally, so I'm looking forward to that. I think what you saw this weekend is over the last week is how complicated Musk's engagement with Trump is going to be. He came out against, so let's go back for a moment. Speaker Mike Johnson, the Republican speaker, made a deal with Democrats to avoid a shutdown, avoid controversy, extend government funding into next year, into March. And in order to put a bunch of things that Congress wanted done before the end of the year, they put together this big bill. A lot of it was bipartisan stuff. Some Republicans didn't like all of that, but it looked like it was en route to passage. And President-elect Trump seemed to deal with it with benign neglect. He sort of talked to Johnson, but seemed to be ready to let it through. Then bang, early in the morning, Elon Musk goes on X and starts blasting the deal. 100 tweets, some of them containing falsehoods, saying it's an outrage, you can't do this. Later in the day, Trump looks like he comes around to the Musk position, and they blow up the deal. Then then Trump says, okay, what I really want is to extend the debt ceiling, which expires next year, because I don't want to have to sign an increase in the debt ceiling. I want Biden to do it. And of course, he wants to do that because he wants to pass a lot of tax cuts next year, a lot of them for the wealthy. Lo and behold, 38 Republicans, very conservative Republicans, say we're not going to vote for Trump's deal because we don't want to increase the debt ceiling. And so they ended up going back to something closer to the original deal. They knocked some of the other stuff that they had put in the bill out. A few of those provisions were later passed by the Senate because they had already gotten through the House. And you had this catastrophe. Now what you have is Donald Trump going out there online and to a conservative group and basically having to say, I'm the president. Elon Musk isn't the president. And of course, Democrats are having a field day with Musk's influence. They started calling him President-elect Musk. And I think you've seen, A, some of the chaos we're going to see next year, and B, a really complicated public relationship between Trump and Musk.
EJ, are we getting the signs here that Elon Musk is not going to be good for investors next year?
I think there are a bunch of things that may be difficult for investors next year. In the Trump program to begin with, the tariffs are not popular among a lot of businesses. There are some businesses that like them, but there's worry about that. But there's also worry that some of Trump's proposals, like the tariffs, like like the roundups to deport people, will be bad with inflation. And so I'm sure you talked about it a lot earlier last week, that the Fed has pulled back a bit on cutting interest rates. And then Musk's unpredictability, or what looks like his unpredictability, markets don't, as you know better than I, markets don't like unpredictability. Fight between Trump and Musk will not be great for government. So, yeah, I think it could be challenging.
You know, I'll go one step further here, EJ, especially as we think about the areas of the market, the 7 names in the market that have outperformed in the Mag 7, and the themes that Musk has intertwined within his own businesses for all of those companies, whether it's XAI or whether it's social media in X or Twitter. And then all you have to think about as well as the overflow of Tesla itself being one of those Mag 7 names in the energy vehicle or electric vehicle landscape. And then I'll round it out with AI as well here. I mean, as we think about all of those things, it seems like there could be a hit to the Mag 7 if Trump is listening more to Musk, who is trying to benefit himself more than the broader market and the competitive landscape.
Democrats raised this issue of what are Musk's interests directly in this spending fight. There was one of the provisions that got dropped out of the final bill had various restrictions on outward bound investment to China. Congresswoman Rosa DeLauro got up and said, did we kill this whole bill just to get rid of that provision because Elon Musk wanted it out there? And Musk was furious and put up on X a tweet that I'm still call them tweets that said, Rosa DeLauro should be expelled from Congress. So you're going to have a lot of this. I think that if Musk wants to play this big in politics, he's going to be under a lot of pressure to do a lot of disclosure so people understand, where is this a matter of public policy and where is this a matter of his own interests? And I wouldn't know what that's like. But when you're that rich, you have a lot of interests in a lot of things.
Yeah, I guess me and Brad can relate. No, absolutely, definitely not. EJ,
Yeah, I'm a Nordstrom rack guy more too.
All right, yeah, well, I like that tie. I could clearly tell that might be coming from Nordstrom. All right, EJ Dion Jr., Senior Fellow at the Brookings Institution and a Washington Post columnist. Good to see you. Happy holidays.
To see you.
All right, while 2024 saw the Federal Reserve cut rates for the first time in 4 years, policymakers are striking more hawkish forward guidance with its recent rate cut. Central bank looking to move cautiously as it assesses inflation and policy uncertainty under incoming President Trump. Meanwhile, slightly more hawkish Fed presidents are set to become voting members in the FOMC as well. Brad, this is really all top of mind here following a chat we just had on opening bid with Mary Daly, San Francisco Fed president. I thought what she said about policy being recalibrated was pretty interesting. Here's what she said.
So I see the recalibration period now as completed. We are back to the time when we can make our decisions more slowly, data dependent, using the data to affect the incoming forecast, and determine how many rate cuts we'll ultimately do next year. We'll have to be agile and data dependent.
Brad, I didn't want to tell President Daly this, but my read was that maybe we do get a rate hike next year. I don't want to say that to her on or off camera, but this is like my brain processing. And just the fact they can't rule out a rate hike because where inflation is right now, it borders on alarming. I mean, this is a Fed that really tried to stomp out inflation. They still have not gotten the job done.
Yeah, it's interesting. And even listening to that soundbite where she was mentioning seeing the recalibration period now as completed here, that could place even more emphasis on other elements of how the Fed can operate. And I'm going to try and make the balance sheet sexy for some reason.
Please make it sexy.
Because it's the only thing that I can logically think that could see a little bit more undulation in the coming year here. And why does it matter here for the balance sheet? Of course, this is the ability essentially for the Fed to hold U.S. Treasury, agency debt. They also hold mortgage-backed securities. And so basically, this helps them offset some of the other elements of the policy decisions that they're making. And here's what you need to know. If there's anything that you remember about what the past few years have looked like, from May 2022 to November 2024, the Fed's balance sheet declined by $2 trillion from $8.9 trillion to $6.9 trillion. They're essentially letting bonds mature and then not selling them into the market. That's one of the only other levers, absent of any severe rate cuts or cadenced rate cuts that we see, that they could possibly pull in 2025 as well here.
Yeah, of course, this is all very important. You have a lot of investors that have bid up Mag 7 names under the thought that we get more rate cuts next year. This lifts the profit margins of these companies, and that's why we saw a lot of these stocks blasted. I will contend, though, Brad, while rates are important, the direction of rates are important, what's more important for these Mag 7 names is the rate of growth. How fast is the AI infrastructure being built out? I understand the first instinct is to blame the Fed for everything and every time the market goes down, especially on big down days, but its earnings growth still matters, and I think as long as AI infrastructure is being built out in this country, you will see that Mag 7 trade come back.
All right, we're going to be watching closely for that, as investors will be, and they're considering the path of interest rates next year following the Fed's hawkish pivot, a cloud of concern hanging overhead in what's been a banner year for stocks. FedWatch Advisors founder and chief investment officer Ben Emmons joins us now with more. Good friend of the show. Ben, great to see you here. First and foremost, as you think about and correlate the Fed's activity and the anticipation going into 2025 with some of the largest market themes that have prevailed during 2024, how do you see that continuing to shape out and the overflow as we get into next year?
Morning, Brad. Yeah, it's a great question because, we're coming off a period of, like you said, a banner year. Right? We feel really good about the economy, we're good about the markets. Volatility is relatively contained. And as much as this Fed has made this transition now from the ending the calibration, as Daly said, to a new phase, as Powell said, we seem to be pretty in control of what's going on. And yet we're dealing with significant uncertainty ahead of us, right? We see a lot of the new announcements coming through from the Trump administration. And although that's all pro-growth, there's also a lot of challenge there. I mean, you just take the news of the Panama Canal by itself, I think that's very significant, or what's going to happen perhaps with Ukraine. So I think of those type of forces in the background that have shaped markets so much over the last few years, an ending of the Ukraine war and the change of the Panama Canal could actually, in my view, infuse the economy here, specifically lower gas prices and more investment, into the U.S. economy. So I do think it's a bullish outlook for the U.S. economy. We could maybe even reach 5% GDP, but it will not go without the volatility. I do think we're going to get average higher volatility next year, simply because we do have a lot more policy uncertainty that we dealt with this year.
Ben, good to see you as always. 5% GDP. I mean, that sounds like a boom. That sounds like an environment that is going to sow the seeds of even more inflation. The Fed raises rates. Tell me I'm wrong.
You're not wrong that way, Brad, but I do think that it is the idea that the economy re-accelerating that's already been happening in the past fall with the incentives, as Trump talks about when he was at New York Stock Exchange. And the word incentive, I think, is really important. That drives that growth rate. You're right, there's no free lunch. It will be with higher inflation. Inflation is stickier already because of the service sector. And goods inflation will be slowly reversing out deflation into potentially again becoming inflationary. So I do think, to your point, it will be somewhat higher inflation environment, which leads this Fed at least to be on hold for longer in the initial stage. Whether rate hike or hikes will happen, I think that's still far out. But higher for longer, as in on hold for longer, I think is quite likely for this Fed.
You, in your notes to us, mentioned that the market is looking like a casino in 2025. As you are thinking about that, the house always wins in a casino, we should also mention here. And so perhaps there's a different way that you're thinking about playing this. But, what are the top games that I would be apt to step up to the table for the market casino in 2025?
Yeah, good point, Brad. Because you enter a casino, you're gonna lose.
You took my headline, Ben. I wanted to ask you that. Go ahead. I just had to get off my chest. Go ahead.
Yeah, exactly. So you look to lose, but this idea of that we're seeing gambling in the markets appear, as the Wall Street Journal sort of nicely described, as well as in retail traders. But think about a bigger picture. People are really geared up for this AI investment cycle. And there's data out from Goldman Sachs showing a huge investment boom ahead of us. In addition to what this Trump administration is planning to do with reshoring, back on shore investment, I think that infuses the speculation and makes it then more casino-like type markets. And that's the issue here, right? The dips get bought really quick, as you saw on Friday, and including today. And as that makes it a shallower dip market, acceleration of getting to a new high will pick up, I think this is where the tension then will come in. If this Fed has to stay on hold longer because its GDP growth is going to go to 5%, yeah, the casino risk increases significantly for markets. I think that's a possibility next year.
Ben, as you look back on the past year, what is the one thing that has surprised you about markets, and what is one surprise you think might take form next year?
Well, for one, we were surprised again by this economy not going, slower than people thought it would be. I also thought that it was the election in itself that people thought was a very big event, and uncertainty actually turned out to be a big risk on the event. People embracing the idea that we're going to go to a different direction with this economy, and that there's a lot of confidence about it. And I think that's surprising given all the negative press that it's gotten. And so I think this is for next year very important. I mean, the NFIB survey showed this huge change in perception about the economy. If that's true, it's going to be more across the nation of people embracing risk-taking. And as we talk about casino risk, but also the risk-taking in the economy, I think that's key next year. If that continues, that animal spirits idea, yeah, I do stick with my view that is going to be a 5% economy.
You got a favorite casino game, Brad? Cards, anything?
Texas Hold'em.
Texas Hold'em, really?
Yeah.
Full disclosure, I'm just really bad at cards. I do have a good poker face, but very bad at cards. All right, FedWatch Advisors Chief Investment Officer and Founder Ben Emmons. Good to see you. Happy holidays. Talk to you soon.
Happy holidays. Yeah, thank you.
All right, coming up on Morning Brief, we'll count you down to the opening bell on Wall Street, and Nvidia has had a weak December. That's not something you hear much about normally. We'll discuss what's in store for the stock and other members of the Mag 7 in 2025. We'll discuss that and much more on Morning Brief.
Now for a trending ticker that we're tracking for you today, which you can scan the QR code below to also track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. First up here, and we got to talk about this one. Honda and Nissan officially beginning talks to merge by 2026. The deal would create the world's third largest automaker by sales. The two companies would aim for combined sales of 30 trillion yen or $191 billion. Talks are set to end in June of next year. This is finally the official announcement coming through from the companies here as we've been tracking closely some of the talks that had emerged, some of the reports and sources saying, but now it's made official here by a statement that came out about 3 a.m. Eastern time here from Nissan, at least published on their investor relations.
Yeah, Brad, this isn't exactly two companies operating at peak performance coming together. I mean, you had Honda sales down 31% year to date as a lot of consumers trade up to crossover vehicles and pickup trucks at the likes of, I should note, our surprise of the year in General Motors. And then Nissan sales down 10% year to date. There are a lot of structural challenges these companies are likely coming together to try to counteract. It is autonomous vehicles, it's new software, it's electric vehicles. So just because they're coming together doesn't mean their future is really certain by any stretch of imagination.
No, not at all. If you want to know, in fact, the circulation of their cars is quite strong in that they made Carvana's top-selling vehicles of 2024 used cars, we should mention here.
I got my last Infiniti, which is owned by Nissan, off of Carvana. They delivered right to my house during the pandemic. Really a great experience. Shout out to Carvana. It's a big year for the stock, too.
Nissan Rogue, Nissan Altima, Honda Civic, those would be the three that are in that top 10. And why is this important, too? And it also kind of has broader implications, too, here, because Nissan, Renault, they have had a years-long partnership that extends to 2030. A question largely of what Renault wants to see from this partnership and what voice they will also lend to the negotiations.
You want to fall asleep, pull up that Nissan Rogue on Carvana and stare at it for a minute. That'll put you to sleep. Really, just
right now.
Poor design, poor design. Look at the, it's just not where it needs to be. All right. It's not working for me. Coming up, it's the opening bell on Wall Street. That is working for me. That's on the other side of the break when more Morning Brief returns.
There you're taking a live look at the opening bell here on this December 23rd, dare I say Festivus Day. There you're taking a look at Americares ringing the opening bell at the NYSE, and at SKK, yeah, the Nasdaq, they're ringing the opening bell there. They've got a little funfetti there on the second floor. Also happens to be where, hey, Brian Sosdy's opening bid is.
Shout out opening bid.
Yes, there you go. Well, from opening bid to the opening bell, there you're taking a look at our bell ringers for today. Let's do a quick check of the markets here. As we begin today's trading activity, the Dow Jones Industrial Average begins the day down by about 0.1% here right now. I'll give you a longer term view here, just over the past 5 days, to give you a glimpse of what's transpired here and some of the pullback that we've seen for the Dow. 2% lower here, and we'll get into some of the components that have been knocking around in just a second here. Taking a look at the Nasdaq Composite, though, you're seeing that begin the day to the upside by about 0.5% right now. And the S&P 500, that's also beginning the day to the upside right now by about 0.2%. So we are mixed on the U.S. major averages. I promised you the Dow components. I'll get to that in a second. First, we'll take a quick look here at some of the sector activity, as we always do. 11 S&P 500 sectors loaded up here for you on the day. Real estate's pulling up the caboose to start today's trading session. Technology is the leader. Oh yeah, for those of you who are wondering how we're doing year to date, as you're taking a look at some of your investments, perhaps you've got the week off tuning into Yahoo Finance on your mobile device or perhaps on your television screen, Samsung TV Plus, who knows? But as we're taking a look and you're doing an assessment of what's done well and what hasn't, energy, that's down right now year to date. That's slower and out the gates, and also over the course of the year by about 0.6%. But take a look at XLC, some of those communication services certainly leading the pack over the course of this year. That's up 35% and outpacing the broader performance of the S&P 500 over the course of the year. That is up by about 24.5%. Dow components, promised you that, and we're going to deliver that. We keep our promises here. All right, taking a look at the year to date, there are some of your leaders as of right now out of the gate here this morning. Intraday, though, this is a look at what's transpiring. You've got Nvidia adding on just a little bit. It's up by about 1.5%. And then additionally, you've got some of the other major and mega cap tech stocks here pulling back just a little bit fractionally for Apple. Microsoft is hyper waffling, oscillating, whatever it is. It's going between gains and losses. And Amazon, that's down by about 0.3% right now. It's time for today's strategy session as well. And our next guest has some interesting thoughts about where equities are going in 2025. Joining us now, we've got Eric Byrich, Sound Income Strategies Co-Chief Investment Officer. Eric, great to have you here with us. As we just laid out how this year has really transpired, your expectations and top plays going into 2025.
Well, great. Thanks for having me. It's good to be here. Yeah, my perspective is a little different than some of the narrative that we've seen. And basically, I think the market is set for a rotation. We've been waiting for it for a while. It's been led by the mega cap technology names or even some of the drug stocks and the GLP-1 data. But as their growth rates slow and their valuation multiples look more stark, we expect them to continue to retreat in a sawtooth fashion, and some of the value names that have really underperformed over the last 2 years to start to rise because their relative growth rates look comparable and their valuation multiples in many cases are a third of that of the market. So that's basically what we're looking forward to. But if you look at the growth rates in the S&P over even the current year, it's actually been negative growth if you take out the Mag 7 names. And even prospectively, with the Mag 7 names slowing, the growth rate going forward, which some have in the double digits, is really hinged upon everything else coming back. So that's a little bit of a difference. And another difference is you guys were really negative on the Fed earlier in your program, and you had some guests talking about it and people talking about the Fed possibly raising rates. I don't think that's the case. Certainly, if you listen to Greenspan's testimony if you listen to Powell's testimony last week.
Well, if Greenspan was still the Fed chief, Eric, I'd be bullish on the Fed. I mean, that guy just cut rates and forever and sowed the seeds of a housing bust.
Dated myself. When Powell spoke last week, he was very clear. He wanted to be very balanced. He didn't, when he was asked specifically if they were going to raise rates, he said he doubted it. And I doubt it as well. If you look at the growth rates across the industries, I'll tell you about those in a second if you want. It's been slowing down pretty much across the board, positive earnings revisions. And if it wasn't for housing being stubborn, inflation would be substantially lower. And it's a 40% factor in the inflation measured in CPI. And it's such a big weight. And one of the reasons why it's up is because the biggest factor in housing is typically interest rates, and the Fed has been creating inflation money and inflation and interest rates. So as rates come down, you're going to see housing inflation come down as well.
Eric, Eric, let me just hop in here real quick. I like in your notes that you called out or tried to define what the average stock is in a market that's still pretty bulled up. And I hear what you're saying on Pfizer. I mean, the valuation multiples, P multiple of under 9 times forward earnings for a Pfizer. I mean, that sticks out. Do you think next year will be the year of the value investor?
I think the value investor will come back next year. There's two arguments for value stocks. One is the mathematical duration argument. And the mathematical duration argument basically says that value stocks do better when interest rates are higher typically. And that's a bond manager's argument. And that's actually going against value. But what's going to help value more is the abject extremes that we've had. So you have the market itself on sort of a PE basis, as defined by the S&P 500, now trading at almost 25 times forward earnings. The average stock on a forward basis is trading at more like 18 times forward earnings. And that includes the mag names. If you take those out, it's more like 16 times earnings, which is normal for the market. So there's a big divergence in what people are paying for these high growth names. And they're paying for them because they're scarce. Well, as the rest of the market starts to grow more and their growth rates slow, it's just going to be a shifting away from the more expensive names, which are still great companies and they have excellent free cash flow. And I'm not knocking them fundamentally. I'm just saying the price has gotten too high. And other things that have had more challenged fundamentals are going to start to look a little more stable and do better. So in the case of Pfizer, we talked about that. I've got a whole bunch of stocks that are under 10 times earnings. Pfizer is one of them, but the earnings growth rate of Pfizer is lower. Yeah. It's in the low single digits now, and that's before you take into consideration the RFK pressures on healthcare and the anxiety, which has created a depression, which is usually an opportunity. Usually, we've talked about this on your show before, valuations are a pendulum. They go too far in both directions. Right. And when people get scared, the sentiment gets overly negative. So it creates an opportunity for a sentiment reversal. So
Eric, with all of this in mind, is there one value investor's North Star that you would be pointing to right now?
The value investor's North Star, you mean besides Warren Buffett? No, and he's been pooling cash, which is a negative thing. But no, I don't know that there's a North Star. What we look for are companies that are cheap with temporary problems that can be resolved. Things are always expensive for reasons. We like to buy things that are cheap for reasons that we think are temporary or not good reasons at all, like technical oversells and things like that. There are good reasons to be negative on most of the value stocks that we buy, but we think there are better reasons if you have a slightly longer horizon to be more positive. So, I gave you guys some stocks for the audience hasn't yet heard yet that are all trading below 10 times earnings, and they all have catalysts for improvement. So in the case of Pfizer, besides the activism involved, they're cutting costs and they have a very good pipeline, which isn't being factored yet because as things make it through phase 2 and phase 3 and get into the market, it takes time and there are launch costs and things like that. So we think there's a reasonable scope in the case of Pfizer or in Glaxo, which we can talk about as well, where their earnings are going to accelerate beyond what's the consensus. And because they're so cheap and because they're paying such fat yields, you get a 6.7% dividend from Pfizer, which looks very secure. Similarly, with Glaxo, you're getting a much improved growth profile, getting almost double-digit earnings growth and a sub-10 multiple and a 4+% dividend yield. Those look like extreme values to us in sort of the large cap stocks.
All right. Eric, we got to leave things there on the day, but certainly do appreciate it and want to continue to have this conversation, especially checking in on the performance of some of these picks that you're mentioning as well. Eric Byrich, thanks so much for taking the time.
Thank you, guys. Take care.
You too. Happy holidays. Now over to Brian Sozzi with our chart of the day.
Yeah, Brad, tasty chart here. Tasty chart. Cue that really bad pun here. Looking at cocoa futures versus Bitcoin. Now, your first instinct is to think, well, Bitcoin has had a tremendous year, broke through 100,000, all these stocks are going up, MicroStrategy's out there buying Bitcoin. Great, and you're not wrong. Yes, Bitcoin has had a great year, as you can see on this chart. Of course, you also see that it really has spiked after that election of President Trump. But cocoa prices, what is driving this, notably, really since the early October here, is some of the biggest deficits in cocoa in 60 years. You have cocoa prices now up 185% year to date. Bitcoin prices, yes, while they have broken through $100,000, up 128% year to date. So cocoa outperforming Bitcoin. Really no correlation there. Just thought it was a cool chart on holiday shortened trading week. Now, what is also interesting, Brad, I'll leave you with this fun fact. While cocoa prices have gone up, you've seen shares of some of the biggest chocolate makers in the world really take a nosedive. Mondelez, of course, which makes Cadbury. Love me some of those Cadbury holiday eggs. Oh my God, they're so good, those cream eggs. Shares of Mondelez down 18% year to date. 30% of Mondelez's business is in fact chocolate. And of course, Hershey, love me some Hershey Kisses, especially during the holiday season. Shares of Hershey down 9%. Put that together. Now you kind of get a better feel on why Mondelez reportedly made a play to acquire Hershey recently. These companies have to find ways, Brad, to join forces and drive down some of their supplier prices, notably cocoa, because they have not been able to raise prices to offset what they're seeing in the cocoa market. It's not like, Brad, you're going out there to raise prices of a Snicker bar almost 200%. Just not going to happen. We're going to leave it on the shelf.
Yes, Oz. I think the new thing is the Cadbury Christmas chocolate mini snowballs.
Wait, are you serious?
I don't know if we've tried that yet.
No, I didn't heard that. I love me the Cadbury. Cadbury has been using that same bunny commercial, I think, since I was a kid in like the mid 80s. I mean, what a hilarious commercial. I mean, you have the bunny there wearing bunny ears. I mean, how do you now go out and buy a Cadbury egg when you're watching that?
Did it ever compel you to get some bunny ears?
I was just a kid. I just love the eggs, Brad.
All right, Saz, thanks so much. We'll continue the conversation in the newsroom. Guys, coming up, look at how AI infrastructure deployments could shape up in 2025. That's next when Morning Brief returns. Wondering how AI infrastructure deployments will shape up next year? Our next guest lays out 5 questions that folks should be asking. Joining us now to discuss, we've got Antoine Chekabin, who is the New Street Research Technology Infrastructure Analyst. And we're not going to run through all 5 questions off the top, but what is the top question that people should be asking about AI in 2025?
Thanks a lot, Brian and Brad, for having me. I would say the top question is about AI scaling. We're now about to enter, the 3rd year of the AI investment cycle that started in 2023. And as you know, a number of concerns that have emerged in recent months regarding the sustainability of AI scaling, or in other words, the ability to increase the performance of generative AI models by just throwing more compute at them. And on that front, well, I would say that the recent developments have clearly shown that, on the contrary, AI progress is very far from over. And is, if anything, accelerating. With the family of O models, so first O1 that was released in September and now O3, OpenAI has made a very significant leap forward towards AGI, with even the most demanding benchmarks acknowledging a genuine breakthrough in AI adaptability and generalization of generative AI models. So to put it simply, these models combine deep learning with the ability to create a new program when facing an unknown task. So in other words, the model likely develops a very large number of possible chains of thoughts to execute a task, organized as a tree of chain steps, and evaluates which trajectory is best. So in some ways, this is actually analogous to what we humans do when we plan a sequence of steps to accomplish complex tasks. And so the performance of these models clearly shows that AI systems will be able to address at least human level and probably suprahuman level tasks in the next few years. And that, of course, is going to drive adoption and fuel continued very strong demand for AI infrastructure spending in coming years.
Antoine, every time one of our viewers or users hears AI, they immediately go right to Nvidia. Now, good thing for us, you do have coverage and you do follow Nvidia. Do you think the sell-off over the past month, Nvidia, is overdone based on the research you have done on AI infrastructure?
Yes, thanks for the follow-up. So I think it is overdone indeed, because as you know, I think that the key concern here that you're talking about is that even if you do believe that spending on AI infrastructure is going to go through the roof, some have voiced concerns regarding the ramp of ASICs. It's those in-house chip programs that hyperscalers have, potentially waiting on demand for NVIDIA GPUs. But what I would say here is that reality is that only 1 or 2 companies maybe have successfully deployed AI ASICs at scale today. That is, of course, Google with the TPU and Amazon with like a number of inferential and Trainium chips. But by definition, ASICs are application specific, which means they trade off flexibility for performance. And on top of that, they like an ecosystem. As you know, NVIDIA has a very strong ecosystem, not just the CUDA software stack, but people know how to use their chips. Today, if you go on Hugging Face and you download a model, you can run it very, very quickly on an NVIDIA chip. It takes you much longer if you want to do that on ASICs. And so the result here is that we estimate that even Google, who has that in-house program ramped at scale, still spends more on GPUs today than ASICs. So GPUs remain dominant for public cloud, pretty heavy workloads and workloads that require high programmability. And so we do expect NVIDIA to remain dominant even if these in-house programs ramp. So we do think that, as I mentioned earlier, on one hand, you have AI infrastructure spending that is going through the roof. On the other hand, you have NVIDIA that is going to remain dominant in AI infrastructure. So we do think that this setup is definitely overdone.
Yeah, it's interesting you mentioned Hugging Face. We've had their CEO and founder, Clem DeLonghi, a few times here on Yahoo Finance, kind enough to give us some of his time. So good to hear him. And of course, the team that is putting the work out there really get recognized here. You think about some of the other, the spread of where investors can be looking at the AI theme more broadly and anticipate for there to be deeper value. Is it within the applications that are built out by existing social media companies? Is it by the agents that we hear some of the largest cloud companies talking about? What is that next shoe to really get worn in by some of the investors here?
So, as you know, the space we cover is specifically infrastructure. But so what I would say on that front is that we're moving from 100,000 chips today in the largest clusters to 1 million chips. That's around the corner. And as I mentioned, like these AI scaling laws increasing that are still completely valid increase our level of conviction that we're going to go there. But another angle that you can take to increase your level of conviction is simply look at the plans of the usual suspects. First, you have like a handful of companies that are reportedly planning to roll out clusters of 1 million chips in 2027. Second, you have OpenAI, who is reportedly planning to increase the amount of money it spends on training compute by an order of magnitude by the end of the decade. So if you're moving from 100,000 chips to 1 million chips, well, on the AI infrastructure front, well, I would say, of course, you have Nvidia, as we discussed earlier, but you also have Broadcom, which is the company that is leading today in ASICs and also in networking to interconnect this 1 million cluster with very, very dense networking to make it act as a single computer so that we can train these very, very large models, these very complex models with the chain of thought capabilities that we discussed earlier. So I would say Nvidia, Broadcom. Of course, you have AMD as well. That's very well positioned. The only alternative to Nvidia for GPUs, they don't sell. So you have Broadcom in ASICs, you have Nvidia in GPUs. AMD sells also GPUs. It's very hard to design a GPU, to design a chip that's as flexible as a GPU. And AMD is the only alternative to Nvidia there. And then I would say in the broader like tech infrastructure landscape, you have, of course, memory. We like Micron. You have TSMC. And of course, I mean, there are dozens of names, but those are the ones that I would say we prefer in the tech infrastructure space.
New Street Research technology infrastructure analyst Antoine Chakaban. Good to see you. Happy holidays. Talk to you soon.
Thank you.
Coming up, billionaire media mogul Rupert Murdoch is unloading some assets. More on this one straight ahead.
We're taking a closer look at some trending tickers this morning, and we're doing it in 30 seconds each. Let's go. First up, Wall Street Journal reporting Xerox is going to acquire printer maker Lexmark for $1.5 billion. This would bring Lexmark back under U.S. ownership after the company sold to Chinese owners in 2016. The deal would be roughly double Xerox's in size.
Plus, Novo Nordisk shares recovering some ground after getting pounded last week. This after disappointing results from its latest weight loss treatment. Novo shares plunged after CagriSema underperformed the company's estimates in a late-stage clinical trial. Analysts at Intron Health noting the sell-off on Friday may have been a market overcorrection. In a worst-case scenario, Novo Nordisk is still likely to haul in $8 billion in peak sales with this new drug, which is about the same amount that Wegovy sold in its first full year, despite severe capacity constraints, said the analysts.
And finally, Rupert Murdoch's News Corp will sell Foxtel Group, its Australian cable TV unit, to British sportscaster and broadcaster DAZN in a deal worth $2.1 billion. The deal is expected to close in the second half of 2025. Shares of News Corp NWSA up fractionally here this morning.
All right, that does it for the morning brief. Stick around. Shawna Smith and I have you for the next hour on Catalysts. Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor. Now let's make some money and get a lot smarter.
I've done Yahoo Finance forever. This is a spectacular spot.
Welcome to Stocks in Translation. I'm your host, Jared Blickery.
Hello, world. I'm Ross Mack.
Hi, I'm Bob Powell, and welcome to Decoding Retirement.
Welcome to Living Not So Fabulously.
Hey, it's me, Tiffany the Budgetista, your favorite financial educator. Welcome to Capital Gains World for a few days and everything has changed.
From Wall Street to Main Street to the C-suite, we are your daily lifeline because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, or wherever you get your podcasts.
Welcome to Catalyst. I'm Shauna Smith alongside Brian Sazi. We're 30 minutes into the U.S. trading day. Let's get you the 3 catalysts that we're watching this hour.
First up, stocks holding steady after D.C. dodges a shutdown. Now the big focus is on whether a Santa Claus rally will help the market end the year strong as investors weigh odds of more rate cuts.
Plus, big tech front and center with AI expected to be a key catalyst once again for the market next year. We've got the top plays to watch.
And the Container Store filing for bankruptcy as bankruptcy surged to a 14-year high. More on what this signals heading into the new year.
Want to get to some breaking news. We have consumer confidence coming in well below expectations. A number out here, 104.7. The estimate was for 113.2. Of course, this coming off the back of what we did see an improvement last month. So a bit of a surprise given the fact that the street was expecting a further improvement here this month. Again, consumer confidence coming in below expectations, right above 104 at 104.7. The estimate was for 113.2. And so this is a bit of a surprise given the fact that we have seen consumers remain confident, but the expectations here were that they were actually going to increase some of their confidence given some of the optimism that was reflected last month when they talk about inflation, when they talk about the fact that they were very confident in the labor market. That's really been one of the drivers here for consumers and their ability and willingness to spend here over the last several months. So again, this coming in below expectations. And I think this also puts into context maybe some of the headlines that investors have been digesting over the last several days as they're trying to figure out just what exactly that rate path looks like going forward, given the fact that inflation has remained so sticky.
Yeah, what bothers me, Shauna, with this report, and then you look at the consumer sentiment report from Michigan, I believe last week, and you mentioned inflation. Inflation expectations appear to be ticking back up. Now, this doesn't necessarily mean consumers are pulling back, but they're concerned, and it might impact their spending decisions in the first half of next year. Maybe the holiday season ended up turning out well, whatever it is, but the sign is becoming clearer, and it really reinforces what I heard from San Francisco Fed President Mary Daly on opening bid last week, that she is not, she's, I think, not inclined, Shauna, to go out there and cut rates at every meeting next year. For her, the word was recalibration. They have recalibrated rates, and she did not rule out a rate hike.
Yeah, certainly. I'm getting a little bit more on this number here. Median inflation expectations, they were at 4%. That was actually in line with what we saw the prior month. Consumer confidence expectations did fall to 81.1 versus 93.7. So a pretty substantial drop there, what we saw in the month of December. Also, the present situation, the confidence, that fell to 140 versus 141 last month. So again, it looks like we're mostly seeing some of that decline across the board, just given the fact that there is so much uncertainty as we do head into the new year.
All right, tech is set to start 2025 on firm footing, according to Goldman Sachs' outlook for the industry. Joining us now is Eric Sheridan, Goldman Sachs Senior U.S. Internet Sector Equity Research Analyst. Eric, always so nice to see you. Thank you for coming to our studio. We really appreciate it. Lots of calls. You have buys on Spotify, Pinterest, Amazon, Google. Uber's probably your big call. We'll get into that. But as you look towards next year, can it be another year with a Mag 7, some of these really big cap tech stocks with premium valuation? Do you think they can put in another year like they put in this year?
I think they can put in another good year. I wouldn't expect the outsized gains that you made in the last year. Last year, I would have said, this is going to be a pretty critical year for striking a balance between revenue growth and investment. Companies struck that balance, but they also increased the ability to return capital to shareholders. And shareholders got very excited about an initial dividend at Alphabet, an initial dividend at Meta, buyback activity across the sector. Next year is going to be a continued year of investment, a little bit slowing in terms of growth, and investors are going to have to digest that. So I think the risk reward is still good, just maybe not as outsized as when we were here a year ago.
Eric, what about just some of the risks, or do some of these smaller companies that obviously we have seen gain a lot of headway over the past 12 to 24 months, do they pose a risk to some of these larger players?
Yeah, I'm not as much worried about competitive intensity from smaller players into larger players. If anything, some of the key themes in the industry require a lot of capital, a lot of engineering talent, a lot of investment into the businesses. So scale is going to continue to be probably the dominant factor of winning across some of the biggest themes: AI, consumer spending, shifts in behavior online, shifts in behavior from desktop to mobile. So we still have a preference for the larger names over the smaller names. There's a couple of mid-cap names we highlighted in our year ahead outlook, but still a preference for larger cap over mid-cap.
You look back this year, and two themes within the big cap tech space is regulatory headwinds, and not a lot of these companies were able to buy other companies or do M&A. What do you think the outlook is with the incoming Trump administration? Do the regulatory headwinds ease? Will we see more big deals?
So what we wrote in a note after the election is that we would think it's unlikely the regulatory environment changes. Most of the regulatory oversight or increased attention for the largest technology companies is already in motion. Alphabet faces 2 cases that are ongoing versus the DOJ. Amazon's going to have a case with the FTC. Meta's going to have a case with the FTC. I also wouldn't expect some of the larger companies to be able to do M&A given their current market position in some of their key verticals. Now, they might look outside their key verticals, digital advertising, e-commerce, cloud computing, and try to expand into new areas that way. Maybe that would find more receptivity. But the big getting bigger via M&A and their core competencies, I wouldn't necessarily underwrite that. I do think, coming back to the earlier point, some of the smaller mid-cap names in the sector might want to merge with each other to gain scale. That could be a theme to watch in the year ahead. Private equity continues to be an interested buyer of technology assets. That's another theme to watch in the year ahead.
Eric, let's get to your top pick in the sector because it caught me by a bit of surprise. We talk about the outperformance of so many of these larger cap tech names. Your top pick for 2025 in the large cap space is Uber. Why Uber?
Well, my team and I are a little bit contrarian. So most of the other names have dramatically outperformed year to date. When we looked at Uber, we see a couple things. Number one, an outsized risk reward. Our fair value is $96. That's dramatically up from where the stock is trading
55%
today.
upside you're looking
Correct.
for? Wow.
With, we believe, not much downside. The stock also has gotten caught up in a lot of debates in the last few months. Number one, the debate around Waymo and what will happen to autonomous vehicles over the next 3, 5, 7, 10 years. How will that impact the way we get from point A to point B? Obviously, some of the moves that Tesla has made, both with respect to autonomous and Tesla's CEO, Elon Musk, and his closeness to the Trump administration. And there's also been a bit of a slowdown in growth because Uber has been lapping some of the pricing dynamics from a year ago. I think we all know that the prices of Ubers are elevated.
$35 for me to get from Penn Station this morning to this office. Like, what's going on, Eric?
So the prices are elevated, but the behavior isn't changing. You're still taking them at elevated prices, so growth is slowing a little bit. So what we always typically look for, especially with our top pick, it was Amazon a year ago, is where is their controversy? Where is their debate? Where can we see outsized estimate revisions and some of these debates getting settled? For us, that's Uber going into 2025.
Is Uber going to cede driverless cabs to Musk? And if so, what's the outlook, not next year, but as you're an analyst, you're modeling out Uber's earnings potential 5 years from now when there might be a couple million of these robo-taxis floating around?
So in our work and in coordinating with the global autos team at Goldman, we believe it is going to be a very long duration cycle before there are enough autonomous vehicles on the road to satiate the demand that are on the streets of Manhattan right now at 10 a.m. Eastern on a Monday. As a result of that, the operators and owners of these vehicles are going to seek yield or return in the interim, and it's much more likely what you're going to see is something akin to the partnership that Waymo has announced with Uber in certain cities, where these vehicles are going to be put into the Uber app. So you're going to be standing on a corner, open up the Uber app, and not only is there going to be the usual choices of different types of supply, but lo and behold, autonomous vehicles are going to be there as well. Because there isn't a human driver, they might be cheaper, but they also might not be as available because there won't be as much supply, so your wait time might be longer. And that's how we think the supply side of this marketplace evolves on the mobility business for Uber.
Eric, getting back to some of your other big picks, you have Google, Amazon, and Meta, you say are among the best positioned buy rating on all of those stocks here heading into the new year. Given what you were just saying before, some of the outperformance that we have seen of these larger cap names, what does that upside maybe more specifically look like?
So Amazon among those three probably has the most upside. We believe Amazon still has exposure to the widest collection of the secular themes you want exposure to in the digital economy. Media consumption habits, shopping, cloud computing, AI. These are all themes you want a lot of exposure to. We also see forward estimates under-modeled for Amazon, especially around profitability. There's been a lot of debate around profitability. The stock became quite mired in that debate in the September-October timeframe, and you've seen the reaction since they guided to profitability the way they did in Q4. So still a lot of operating estimate torque for Amazon that we would want exposure exposure to. Plus, to go back to your earlier point about the consumer, Amazon does appear to be an outsized winner in the holiday shopping period from what we track.
You do have some names you don't like, and on your list, you have a sell what on eBay. I get it, like it's eBay. I mean, they sell like auto parts or whatever they're doing. But Airbnb surprised me. What is that a peak travel call?
So what it is the normalization of travel. So our view is that travel benefited dramatically from the summer of 22 through the summer of 24. We all got out of our homes. We all went to Europe. People went to see Taylor Swift in Italy and things like that became very popular. Away from that, we see a normalization to high single-digit growth, but the industry still needs to make a lot of investments. So a growth investment slowing while making investments and somewhat depressing margins, we don't love that setup from a risk-reward standpoint going into 2025.
All right, Eric, always great to have you. Thanks so much for making the time, especially joining us here on set today.
Thank you. Happy holidays.
Thank you, too. Opposition from President-elect Trump and billionaire Tesla CEO Elon Musk saw Speaker Mike Johnson's original spending bill implode last week in the House. Now, a slew of priorities left off the final agreement will be added onto the growing 2025 to-do list for Republicans. We want to bring in Laura Weiss, Punchbowl News tax and financial services reporter, joining us now. Laura, a lot to break down. I think one of the big takeaways from what has played out over the last several days is the disagreement that's clearly evident right now within the GOP party. When we talk about the to-do list, the longer and longer to-do list here for Republicans, so much of that was what has gotten the market excited here over the last month and a half. Does this signal a very bumpy road ahead, and what should we expect?
Yeah, it absolutely does signal a bumpy road ahead. I mean, you saw this week, keeping the government open, that's really one of Congress's most basic jobs. Republicans thought they had a deal. And then, Elon Musk and then President-elect Trump were not on board and really came in at the last minute to make this much, much harder. And then you saw 38 House Republicans were really unwilling to take the deal that President-elect Donald Trump wanted. He wanted the debt limit sort of cleared away for the next 2 years to make his first couple of years in office simpler and easier, and they said no. And so I think that really showed how difficult, especially the House, is going to be next year. There's an extremely thin majority for Republicans. They're, for a while next year, expected to have basically a 1-seat majority because of some, House members who Trump tapped for administration posts. And so it's going to be extremely hard to wrangle them and get some of those things that, like you mentioned, the market's excited about done, like tax cuts.
Yeah, Laura, it sounds like getting those tax cuts extended is by no means a done deal.
Yeah, I mean, basically there's a deadline here, right? On December 31st, the Trump tax cuts, much of them from 2017, expire. And taxes would go up, if that is allowed to happen. And that would be a disaster for Republicans, really, who ran on tax cuts. And so I think it's still, not looking like that's going to happen. They're planning to pass a tax bill that's going to be on the very top of the priority list. But there are certainly members of Congress I speak to who are really concerned about this getting done because they know how important it is to their agenda and to Trump. But the House is going to be a really difficult place to get agreement. And we've seen that the last couple of years. We saw it last week, and we're expecting it again next year with an even thinner majority.
Laura, how should we be thinking about Musk's power over Republicans and maybe what that signals in terms of those spending cuts, tax cuts, everything that's really been driving some of the trading action over the last couple of weeks?
Yeah, I mean, we absolutely saw Elon Musk flex power, tweeting up basically a storm about the CR. And ultimately, the bipartisan deal that Speaker Mike Johnson originally had fell apart when that happened. And, it was ultimately President-elect Trump and Vice President-elect J.D. Vance who came in to deal that final blow. But Elon Musk was certainly creating problems, and people were very aware on the Hill of that, concerned as that started to kind of happen, and he was continuing to tweet against it. And so I think it shows the influence he has after being an absolutely huge supporter of Trump. And, next year, obviously, he's working on this Department of Government Efficiency, DOGE. And so that's going to be a really influential project as well. I think Republicans are already showing they take that very seriously. They're talking about huge amounts of spending cuts, and I think that's something they'll look to DOGE to kind of identify for them and try to help unite them, because they are talking about $2.5 trillion of spending cuts. And spending cuts in Congress, they can sound good at first to Republicans, then you start to find political problems. And it's really, really hard to get together on a set of spending cuts.
Laura, you know who flexed president-elect at a bro-type event over the weekend, saying Elon's not becoming president. He's not some former shadow president. Do you think this relationship just ends really badly?
I mean, that's certainly a possibility. It's certainly in a situation like this. I mean, I think that you saw last week, one of the things that Democrats in Congress honed in on was saying, oh, it looks like a president-elect Musk right now. And I think you saw them doing that because they knew it would get under Trump's skin. They knew that that would be sort of a real needle in the side. And, you know, but Musk, we'll see how much his influence lasts. And I think either way, we're seeing a lot of the dynamics that, you know, from a Trump return to Washington, there are some really powerful figures, whether they're in official positions or not. If they've got his ear, it's a powerful place to be. And we're seeing Trump sort of make last minute decisions to come into these congressional negotiations and make his stamp. And he, you know, not minding that it might make life a lot harder for Republicans in Congress. He's going to want what he wants.
Fun time to be a journalist, right, Laura? It should be a very interesting year. Laura Weiss over at Punchbowl News. Really enjoy your work. Happy holidays.
Thank you. You too.
Coming up, we're looking at today's Yahoo Finance trending tickers. We'll give you the news behind the moves next on Catalyst. Now time for a rapid fire look at some of Yahoo Finance's trending tickers. Scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page, one of my favorite pages. First up, Tesla may be struggling with its Cybertrucks as signs point to slowing sales. According to reports, the company may be removing badges from limited edition models to sell them as the cheaper ordinary version. Tesla also launched the first Cybertruck leasing program last month. I can't say I'm surprised here, Shona, because these trucks are so damn big, you can't even put them in a parking spot. So really cool chart over here by the folks over at Car Gurus, and you can really, they track the prices of these Cybertrucks. You can see over the last 30 days, prices of Cybertrucks, and you can see it there on the screen, just a big hulking truck. Sales of, or price of Cybertrucks down 3.19% the past 30 days, down 10% in the past 10 days. I'm not saying these are, you know, not cool looking, whatever it is. I mean, there's just a lot of upkeep involved. I mean, if the stainless steel on the outside gets dented, I mean, you have to get it replaced. I mean, some people are wrapping these things. I don't, whatever. It's ridiculous.
Yeah, I mean, there's a couple of things going into it. One, I will say that this is the only car on the road that my 5-year-old ever recognized or is ever really paying attention to. So I think that just speaks to exactly what it looks like and maybe who that audience is, if he's really zeroing in on that. Exactly, and not exactly what you want here. And I think when you take a look at that price tag, to no surprise, they are going to need to I guess boost the offerings just a little bit, incentives in order to get more sales out the door. Over the weekend, though, did you see what Kim Kardashian did?
She just bought a Cybertruck?
She gifted one of her closest friends a Cybertruck. And when you take a look at her past social media influence, I bring this up because she has had a real effect on sales. So that will be interesting to take a look at in the new year, the coming weeks, whether or not that does have any sort of influence at all.
If I was that friend who got this Cybertruck, I'm wondering if Kim is really my friend. I would just punt this one back. I mean, where are you going to park this truck?
I wouldn't.
I mean, where are you going to park this truck? I mean, you can't park it anywhere. Come on.
I would gladly accept this Cybertruck.
Really?
Yeah, why
really?
not?
Where are you parking it?
Look, I have no idea.
Exactly.
But that's
we ask the tough questions
problem.
here, Yahoo Finance. That's my follow-up.
But yeah, but it is interesting to see, and obviously this could be a real challenge in all seriousness going forward here for Tesla as we do try to figure out what exactly that adoption rate is going to look like.
Get your 5-year-old one of these, Shona.
Oh, God. It's a little out of my price range there, Saz. All right, let's take a look at Palantir and Anduril reportedly in talks with a dozen competitors to form a tech consortium to bid for Pentagon contracts. Now, this is according to the FT Financial Times. They want to take a bigger share of the government's $850 billion defense budget from traditional contractors like Lockheed Martin, RTX, and Boeing. Now, this consortium plans to announce it has reached agreements as early as January, and companies in talks to join, including SpaceX and also OpenAI. So what does this really mean here, just moving forward? Obviously, just that $850 billion figure in the defense budget, to no surprise, are doing all they can to compete better against those handful of names that we just listed there that have dominated this space. How successful they are going to be. I mean, when you take a look, just take a look at Palantir, for example, how far that stock has climbed since the start of the year. A lot of that momentum being driven by what exactly that their footprint could look like here in the years to come. But I think the ability, how quickly they're going to be able to take away some of those contracts is the big question.
Yeah, and I wouldn't sleep on Anduril too. This is a company we had Brian Schimpf at the Invest Conference. Our very own Josh Lipton interviewed him. Really awesome chat. You can go back to Yahoo Finance, check out Invest, and listen to that interview. It is definitely worth another watch. Anduril last valued at $14 billion on a capital raise last summer. I am really interested, Shona, what that next capital raise looks like for an Anduril. They will likely raise more capital. What does the valuation look like? An environment where you probably will see more defense spending under the Trump administration than the Biden administration. I mean, that valuation, why can't it double? Why can't it triple?
Yeah, you talk about the astronomical growth that it's seen. This is a company that was founded only back in 2017, so not too long ago. You talk about $14 billion valuation, to your point. That could potentially climb, and relatively quickly. All right, coming up, we are taking a look at a pair of retail stories. We've got Nordstrom reaching a deal, and we also have the Container Store declaring bankruptcy. Got the two stories for you when we come back.
Nordstrom will be acquired by the Nordstrom family and Mexican retailer Liverpool. Let's bring in Yahoo Finance's senior reporter Brooke De Palma. Brooke, you've been doing work on this one. This deal was a long time in the making for Nordstrom, but raises, I think, questions on what other retailers might do, struggling retailers might do.
Yeah, absolutely. It raises questions on what Macy's plans to do. Of course, they've received numerous buyout offers this past year, as well as Kohl's. We know that there's a new CEO stepping at the helm of that company in mid-January, coming from Michaels. But let's get to the details of this deal from Nordstrom. What we know so far is that this is an all-cash deal valued at $6.25 billion. Now, shareholders are set to receive $25.25 per share in cash. That's roughly around the same share price that we're seeing right now. The offer price is a nearly 36% premium to where shares started this year at nearly $18. And this deal is expected to close in the first half of 2025, pending shareholder approval. Now, experts I spoke to this morning said that they do expect the deal to go through at the proposed price, given the fact that the Nordstrom board of directors, which includes Eric and Pete Nordstrom, have unanimously approved the deal. And in addition to that, there appears to be a lack of apparent opposition to the deal. This expert that I spoke to believes that both parties are getting a quote-unquote good deal here and buying Nordstrom when he believes that results are depressed. He does expect results will improve, and insiders know this, hence the reason why the deal is happening now. Of course, this has been in discussion for quite some time now.
Yeah, certainly. I think there is some questions, though, about that confidence and exactly what that timeline looks like in terms of some improvement at Nordstrom. Brooke, you've been very busy. I know you were also all over the story about the Container Store last night, filing for bankruptcy, something that you had talked about that was a potential here over the last several months. What do we know now?
Yeah, we know that it just couldn't keep up in this environment where consumers are facing persistent inflation. They're also facing pressure, as well as they're reducing their spending. In this particular categories, they really focus on essential goods. Here's what we know so far. This Chapter 11 bankruptcy will allow the company to receive $40 million in new money financing. As a result of this, the company says that this Chapter 11 bankruptcy will help the company bolster its financial position, fuel growth initiatives, as well as enhance long-term profitability. We know that the company is looking specifically within that custom spaces category. They said that that's doing well. But overall, the company said that it will operate as usual. The customers' deposits will be safe. We know that vendors will get paid in full. In addition to that, sources close to the matter said that there's no planned layoffs as well as no store closures as of now. But of course, it's important to point out that there are 102 stores in 34 states. And sources also close to the matter did say that this will also allow the company to renegotiate the terms of their leases. And so we could see some potential or possibility that if it's not up to par, it's not what they want here, those stores could close.
Yeah, good stuff breaking that one, Brooke. Weren't they supposed to merge with Beyond, or would they have a deal with them?
They certainly were, and that is no longer going to happen, according to sources once again. That was offered back in, I think, November, recently. October was it? But what we now know is that that's no longer going to happen. It won't come to fruition. That's, of course, the company behind Overstock.com, behind Bed Bath & Beyond. They announced that they were going to invest $40 million in the Container Store. They explored that. The deal did not materialize.
And this is part of really a lot more companies going bankrupt.
A lot more. It's like we're ending the year.
Household names going bust.
Party City. We see Big Lots going out of business officially as of last week. And U.S. bankruptcies filings are on pace, as you can see right here, to reach the highest level since 2010. And this really speaks volumes to what we're seeing right now, this rise of Walmart and Amazon and these other players not able to keep up with that low price as well as convenience play here.
Yeah, wow, 14-year high. That really just tells how tough some of that competitive landscape is out there. Right, Brooke? Thanks. Well, Intel, Nike, Starbucks, and Stellantis, all companies that saw their chief executives depart this year. We're going to be taking a deep dive into why 2024 was the year of the CEO exit. Plus, some challenges facing the incoming CEO of Boeing after a bumpy year. We've got the breakdown on what to expect in 2025 next. 2024 has been a big year for changes at the top. There's new data out from Challenger Gray and Christmas that found 327 CEOs of public companies left their post this year. That's an 8.6% jump from what we saw a year ago, and is actually on track for the highest number that we have seen since the firm started tracking this in 2010. Now, that number includes CEOs of companies like Boeing, Intel, Nike, and Starbucks, the stories that we have covered very thoroughly here on Yahoo Finance over the last several weeks and months. So here with more insight as to why we are seeing this, we want to bring in Bill George. He's a former Medtronic CEO and Harvard Business School executive fellow. Bill, it's great to have you here back on Yahoo Finance. Talk to us just about what you think is behind the mass exodus that we saw this year.
The irony is that the economy is very strong right now. And I think boards of directors are really triggered to shareholder pressures, a missed quarter, a difficult time. And, these CEOs, I know most of them personally, they're really outstanding people, and some of them haven't been given enough time. I think Lakshman Narasimhan had 16 months to try to turn around Starbucks with 400,000 employees. That's just a good example of how tough the pressures are on CEOs today. Again, I think boards are a little moving too fast, in my opinion. I think they need to give these CEOs more time. And we see like somebody like Kelly Ortberg at Boeing, that could take 5 to 10 years to turn around. Pat Gelsinger only got about 3 at Intel, and that's a 2-decade turnaround. Looking backward, it's going to take some time for them to get new technology to market. So in these businesses that have a major turnaround and a large number of employees, it's going to take time. So I'm concerned about how fast they're moving.
Bill, in this environment, what makes a good CEO?
What makes a good CEO? Well, I think a good CEO today not only has to know how to run the business internally, make the numbers, build a very strong organization behind him or her, but I think they also have to be keenly attuned to external events. And this is where many of them are not prepared for what's coming at them. Look, we've had high inflation, 2 wars, and we don't know quite what's coming in terms of government administration is coming next. And they have to be very, very responsive and frankly pragmatic to adapt rapidly to changes. So it's not just that you have a 5-year plan like we used to have and you stay the course. You really have to be very adaptive to what's coming in your marketplace with your customers and to external events. That is the key. And that's where I see many CEOs falling short. They aren't able to adapt rapidly to those external factors coming at them.
Bill, there also has been this trend of putting temporary leaders in place as we do see these CEOs stepping down. Is there a real risk factor there that investors should be aware of?
I don't like this at all. What happens is sometimes boards decide we're changing the CEO, like Solana said, very quickly. And so they put someone in charge, they grab for someone in charge without going through a thoughtful search. We saw that way back at Boeing, where David Calhoun came in. They really need to take their time. Yes, you can put someone in for a few months, but take their time and find the right CEO. And so I think the idea of an interim CEO is a bad idea because it takes a long time to turn around these enterprises. Maybe you can get the numbers right by cutting costs, but you can't transform strategy. You can't move the whole culture. And a lot of these organizations have deep cultural problems like Starbucks does, like Boeing does.
Bill, I don't want to put words in your mouth on this one, but as someone that used to lead be the CEO of a public company, a large one at that, you have to be blown away by what we're seeing with the relationship between Elon Musk and President-elect Trump. I mean, Elon is SpaceX CEO, Tesla CEO. We've never seen anything like this before.
No, we haven't. And, capitalism has had a peak in the United States right now. I was just with a group of 250 CEOs out in New York this past week. And capitalism is doing really well. Our economy is at a peak. And these CEOs are running their companies really well. But we could fall into crony capitalism, which to me is exactly the opposite, where it's who has relationships. I think that's one of the reasons you see some very qualified CEOs like Tim Cook and Mark Zuckerberg, former CEO Jeff Bezos, going and meeting one-to-one with President Trump to try to ensure some believable level of stability and predictability in what's going to be ahead. And they don't want personal attacks either.
But one of the big headlines that, of course, we've been following here over the last several days has been the tragic killing of the United Healthcare CEO, Brian Thompson. I bring this up just in terms of maybe what this signals for CEOs or CEOs of various subdivisions within public companies and the criticism that they face from the American public and beyond. I'm curious from your perspective, could what happened to Brian Thompson, the tragic killing of Brian Thompson, could that intensify this trend away that we have seen from the corner office?
From what?
From CEOs.
Look, first of all, this is a terrible situation, and I'm totally shocked that 41% of Gen Zers are saying it was acceptable or somewhat acceptable. Every CEO I know is running for the exit, so to speak, to get their security beefed up, but they don't really want that much security. There's not such thing as perfect security, but I think it's totally unfair. But there has been huge criticism, particularly the healthcare insurance industry. And anytime there's that much criticism coming at you, it's time to take a look. We faced this in the banking industry after the collapse in 2008 and 9. I remember I was on the Goldman Sachs board and under Lloyd Blankfein's leadership, we led a major inward look at how we could make things better. And I think all corporations need to do that, making it better for their customers. A lot of companies say, oh, we're doing fine with our customers. But until you look at how it's seen from the customer perspective, which in the case of healthcare insurance is not pretty, I think you need to respond to that and rethink all your policies and practices to make sure they're customer friendly, because that's what customers and consumers are going to demand going forward.
Former Medtronic CEO Bill George, always nice to see you. Tremendous insights as always. Happy holidays. We'll talk to you soon.
Thank you very much. Happy holidays to you. Thanks for having me on the show.
Thank you. All right, it's been a turbulent year for Boeing. The stock down roughly 32% this year, from the door plug incident towards the start of 2024 to a shakeup in executives in the months that followed. The airplane maker faces the hefty task of a turnaround. Gabelli Funds portfolio manager Tony Bancroft joins us now with a look at Boeing. Tony, good to see you here. I'm really concerned about the company's financial statements going into next year, notably the cash flow that they're generating, what else they might have to do to shore up that balance sheet. I mean, take us through how you think about it here. Is Boeing, do they need to raise more cash? Let's start there.
Thanks, Brad. Great to be back. I don't think they need to raise more cash. They went to the market and had a huge equity issuance, and I think they'll be, as well as debt, convertible debt, and I think they'll be pretty well capitalized for at least through next year. I think the bigger issue now is just actually getting the production line up and running, obviously efficiently, safely, and sort of hitting the numbers that they're talking about. They're obviously putting out, trying to get to 38 sometime next year, and sometime in the second half. There was actually a report speculating that they could even, they're talking internally to getting to 38 sometime in May. It sounds pretty, aggressive. I think as long as you're seeing the trajectory going positive, that's going to be a good sign for Boeing. The supply chains, the other long pole in the tent, with the engine manufacturers and a lot of the forgers and castings still needing to expand their capacity and continue to grow. So I think in the near term, that's probably where Boeing is looking at to have the stock sort of recover in 2025.
Tony, I had the chance to attend Goldman Sachs' Industrials Conference earlier this month, and I had a chance to speak with Noah Papanak. He's the analyst that covers Boeing there, and I asked him just what Boeing needs to do in order to better turn around the business, to better position the business for 2025. And here's what he told me. I want to get your reaction on the other side.
Well, they have a defense business that's underperforming pretty significantly, and so, they have, a half a dozen programs that are losing money in defense. I don't know how many businesses that makes up, but if they can sell something in defense that's currently loss-making to them but would have value to somebody else, you just instantly get those losses off the books, and you can concentrate more on the aerospace business. They also have, in addition to the new plane business, they have a services business, but if you can get a very high multiple and therefore a lot of cash and even further pay down the debt load that they have, that could potentially mathematically be a good idea. So those are some of the things that they're looking at.
And Tony, as we talk about efforts here potentially to streamline Boeing's business, I guess the question is what that timeline looks like for investors there, just in terms of that strategy. What is realistic?
Yeah, I think Noah made a good point, Shauna, and I think there's certain programs that make sense. I think, for example, the space business, ULA, their Starliner business, the SLS, those are competing against SpaceX and other competitors, which have probably newer systems, newer programs, newer technology that it's not a comparative advantage to Boeing, I'd say naturally. So I think programs like that could make sense. They've already talked about the Jepson high charts business. It's probably non-core businesses within Boeing that could go. But I think Boeing has a lot of core defense businesses, they by far have a comparative advantage. For example, the KC-46 tanker. They've got, they essentially make that airframe. They make the 767. Of course, the P-8 anti-submarine warfare aircraft, which is essentially a 737 NG. There's no reason for them not to own that business, make that business. And in the long term, you got to remember these are long-term programs, 30 plus years. And they have in the near term, they have these, they call them estimates at completion, EACs. And these adjustments, they try to sort of figure out, hey, what's the profitability, of this program? And they have to put an estimate on it, and they have losses and gains. But I think over the long term, they become they'll be good programs, particularly the ones that are the airframes that are inherent to them.
Tony, President-elect Trump reportedly not too happy that there may be delays in the next version or iteration of Air Force One. How much of a risk is it to Boeing that they may become back in the headlines from President Trump because they can't get this plane, and that provides headline risk to Boeing at the time where it's just trying to regain investor confidence?
Yeah, that's a good point, Brad. I think, it's obviously there's a lot of volatility there with the new administration and what occurred in the past regarding the Air Force One program. Obviously, it's two aircraft, and they've taken a lot of losses on that already. And they've already noted that wasn't probably the best, best contract to bid on and get. But I think over the long term, they'll probably make it work out. And again, it's a very long term program. The 747 has been flying for multi decades. So probably in the end, it'll be fine. But you'll probably see a lot of news and volatility in the near term.
Tony, how confident are you that Kelly Ortberg's the right person for the job? I know you and I have talked about this time and time again. Now that we're learning a little bit more just about what that roadmap looks like or the path forward here for Boeing, how much more, reassured are you?
Yeah, I think so far he's put a good game plan together. You're hearing all sort of positive news and anecdotal items out of Boeing with how it's progressing and post strike. It's one of our largest holdings in our Gabelli Commercial Aerospace and Defense active ETF, Aerospace and Defense ETF. And I think in the long term, Boeing is going to do very well. Again, they have a $500 billion backlog just in the commercial business, 6,300 planes. That's almost 7 years at run rate and 10 plus years now. And they're going to be building planes with a lot of operating leverage in airplane production. Remember, it's a duopoly, highly variable, relatively low volume, but that incremental plane that comes off the line is extremely profitable, and it's going to lead Boeing into the sort of the next generation of aircraft. It's going to be a good program.
All right, Tony, thanks so much for taking the time to join us.
Thanks so much. Happy holidays.
You too. Some breaking news this morning. Luigi Mangione, the 26-year-old accused of killing United Healthcare CEO Brian Thompson, has pleaded not guilty to state charges of murder and terrorism. Mangione faces 11 charges, including 1 count of first-degree murder and terrorism, and 2 counts of second-degree murder. Now, Mangione also faces federal charges. The state case is expected to go to trial first.
path of rate cuts in 2025 is hanging over Wall Street in the last couple weeks of the year. The Fed's outlook of 2 cuts instead of 4 rocked markets last week. And the Fed is not ruling out a rate hike if central bankers see a reacceleration of inflation. I spoke with San Francisco Fed President Mary Daly last week on our opening bid vodcast. Here's what she had to say.
I never rule out anything, honestly, because that's a recipe for being behind or making mistakes. So I don't rule anything out, but I can tell you where I think the most likely place will be. We could have fewer cuts than 2. We could have more cuts than 2, depending on the data. Of course, if inflation, for whatever reason, started to accelerate again, then absolutely I'd be supportive of adjusting the rate upwards. But I don't see that right now on the horizon.
Interest rate traders see the Fed pausing its rate cutting cycle in January, according to the CME FedWatch tool. Here with more is Max Wasserman, Miramar Capital co-founder and senior portfolio manager. Good to see you this morning. You just heard that Mary Daly quote, San Francisco Fed president. Do you think the Fed, just given where inflation is, Max, do you see them raising rates at all next year? Because I think that's what still has many in the market spooked.
Well, thank you for having me on. And the answer is yes. We felt that the Fed was too aggressive easing. And with the economy, we think much stronger than they anticipated, roughly GDP around, let's say 3%, and inflation hovering around 2.7. We think that doesn't warrant such aggressive cutting. And if you look at a stronger economy, employment's still good, and changes in fiscal spending, we don't see the need for the Fed to be so aggressive. And if you think about it, the Fed just did about shift. They just outpaced. They just did that last week. They've gone from 4 to 5 to maybe 2. So I think the first quarter of next year is going to be really telling what the Fed's going to do, given that we think the economy is stronger than they anticipate. You have new fiscal stimulus coming in, potential changes in immigration, tariffs, everything. It just doesn't warrant an aggressive cutting.
Max, what about the odds of a rate hike here? Because Torsten Slok out this morning saying that the odds of that is actually right around 40%. Could that be something, or I guess how realistic maybe is that scenario in the new year?
I think it's very realistic in the second half of the year, or even in the second quarter of next year. If you think about it, if the economy is not slowing down, if inflation's as sticky as everyone believes it to be, then the Fed is basically overshot on cutting. So I hope they don't have to do an about face. I hope there's not inflationary pressures, but it looks like with the new policies coming in and the growth, it's very hard to justify easing. So if they maintain it, that's one thing. But if you get a tick up in inflation, then the Fed was going to have to make a change in course. And the market's not pricing that in. And I believe the market's not even pricing in the Fed stopping cutting interest rates. I mean, the market's been all over the place, but there's a lot of risk, we believe, in the equity markets and the bond market.
If a base case, if a hawkish base case is in fact where you're thinking the Fed goes next year, I mean, how are you positioning the portfolios today? Is it more defensive? Is it more value-oriented names?
Sure. So first of all, we think you have to de-risk, especially given the move in the Nasdaq and the top 7 stocks. We're not saying get out of them, but to take profits, it makes sense. We see the equal weight part of the market actually outperforming. We think there's more value there. We're dividend growth investors, and one way to do that, to de-risk, is we like dividend stocks because that would bring you cash flow. So if interest rates are going up, you can take that cash flow and reinvest. We also think you should be shorten your bond duration. We think it should be short term. If you think about it, since the Fed cut last time, the 10-year is 4.50. We could see the 10-year going to 5%. And if that's the case, you don't want to be locking in right here on a 10-year paper. Stay short term. We think it's more prudent, and give it a quarter or so. Let's just see what the data comes in. And if the Fed does make about face, then you'll find that de-risking makes sense. Look what just happened last week. Just a hint of not cutting. You saw the Nasdaq give up 3.2% in a day. Now, the market's recovered a lot. But just imagine that if they don't, and you could see another scenario like you did in 22 in December of 2018. So we think it pays to be cautious, especially after this major run-up in the Nasdaq.
Max, you mentioned a number of times the policies from the incoming administration and what exactly needs to be factored in here when we talk about the Fed's path forward. From your view, what is the biggest risk from the incoming administration for the market?
Well, I don't see, if you're really going to change immigration policy substantially, I don't know how it doesn't affect agriculture. If you're really going to put major tariffs, I just don't see how that doesn't affect energy prices. I mean, Canada, for example. So I don't see how these are going to bring down inflation. These are more inflationary policies. And if you look at it, both the Democrats and Republicans love to spend money. And if you lift the debt ceiling, which it seems to be happening, there's no reason that the debt shouldn't go up. And the debt service is over 1.2 trillion a year. So you have a lot of paper that was financed during COVID on short term that's rolling over. So we think there's going to be a lot of upward pressure. And if everybody's looking at cutting taxes further, we see that inflationary. So we think those policies, along with a strong economy, again, the GDP is roughly around 3%, and we're seeing sticky prices. So I just don't see where you get lower interest rates in this environment.
Miramar Capital co-founder and senior portfolio manager Max Wasserman, good to see you. Happy holidays.
Thank you so much. Happy holidays.
Appreciate it. All right, coming up is Wealth, Yahoo Finance's show dedicated to all your personal finance needs. Brad Smith has you for the next hour. Do stay tuned.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, the tools, the tips, and the tricks that you need to grow your money. Hey, on today's show, we're taking a look at the markets in the past week and a half, of course, of 2024 here. This is all as we're trying to find new opportunity into the new year with lagging sectors here and financial goal setting in the new year. We'll talk about the money moves that people are considering in 2025. Plus, Yahoo Finance's 2025 retirement outlook. Our personal finance expert, Carrie Hannon, breaks down the biggest changes coming to retirement in 2025. All that and much more during today's show. But first, let's back up, hold up, wait a minute. Can we put some markets in it? Taking a look at 90 minutes into the trading day, and we've got some mixed activity here. Dow Jones Industrial Average right now lower by about 0.7%. S&P 500 fractional declines there. The Nasdaq Composite holding on to some gains by the hair of its chinny chin chin. It's up 0.1%. So stocks right now mostly lower to kick off the holiday shortened trading week. Joining me now, we've got Matt Powers, Powers Advisory Group Managing Partner here. Matt, great to have you back on the program with us. I want to talk about one of your topics heading into 2025. A lot of people are focused on, will I get my package in time or not? And that frame of mind might permeate over into 2025 as well with this name that you like, UPS. Explain why.
Yeah. Good morning, Brad. Thanks for having me on. It's with the way we're looking at next year and really in general, and kind of to preface the UPS, to get it out there, we're saying continue to maintain the AI trade. So Mag 7 companies that are derivatives of the Mag 7, they've got growth and defensive characteristics and high valuations, which might lead to some multiple expansion, but earnings growth should continue. So with that, we continue to talk to our clients about some different areas and more of a back to basics approach. And within there, UPS falls in that category. So to answer your question, simple here. It's an opportunity to lock in a core holding with a high yield. It's over 5% yield, and it's got a strong dividend growth. It's over the past 10 years, they're over 10%. Past 3 years, over 17% a year. But clearly, the shares have been beaten up year to date, down 18% this year, mainly because operating margins have been tightened. But it appears they're expected to improve in 2025. Plenty of positives for UPS, a lot of cyclical tailwinds, but for us, we just look at it as an attractive holding at a good price.
For the tailwinds that you're citing here with UPS and spotting with UPS, where else do you think that could also be spotted within the market as you think about some of the larger themes that could play out in investors' favor next year?
Yeah, what was interesting, and we talked about you just said something about the past week and a half, but the Dow. So the Dow, and I'll get this out a little bit, but it's it's down almost 6% since December 4th as of last Wednesday's close, and that's 10 straight days of declines. It was the longest streak in 50 years. So the issue that we see with the Dow as an index is it's weighted by share price, and I'd argue it's dated and lacks some relevance. So United Healthcare is the second highest share price in the Dow, second highest weighting. The United Healthcare is down like 20% in that time period, but we look at Amazon and Apple are towards the bottom, and they were actually up in that time period. So it's been looked at as a proxy of the economy, and it was initially built with some narrow breadth, and the concentration of the 30 companies makes it less representative of the overall economy. So the point being, 10 days made all the headlines, but you didn't see the same performance out of the S&P and the Nasdaq. They were both slightly down in that time period.
You mentioned the S&P 500. Looking out into 2025, the calendar year 2025 earnings growth expectation from FactSet, 15%. It seems like that's what analysts are looking for here. What is the pathway to that 15% earnings growth, at least as you're looking across the S&P 500 and really gauging where the other 493 non-Mag 7 players will be able to kind of step up and see some of that broadening?
Yeah, so broadening, it looks like, all 11 major sectors are actually expected to have year-over-year earnings increases in 2025. And I think we had or will have 7 of the 11 this year, which suggests broadening out. But the S&P's trading at 21 times forward earnings, while dividend growth equities, which is kind of our core focus, are at 19 times. So we see, again, going back to that back to basics approach, shifting towards value and just underappreciated areas of the market. One of my recommendations, which might be unpopular here, is the XLP, which is the consumer staples sector. A lot of individual names in this sector we like, and it's an easy way to gain exposures by looking at the broad-based ETF. But most ETFs and funds in this area have Costco and Walmart as top holdings, which they're stretched in valuation, but we like them a lot. It's an out-of-favor sector. Definitely, again, a back-to-basics approach on flagship U.S. names, and most companies are dividend payers with a long history of growth.
Just lastly, while we have you here, Matt, how are you evaluating the FOMC going into next year? It seems that, of course, even with the cut that we saw come forward in their final meeting of the year, the market's really focused in on exactly where the potential for maybe just 2 cuts next year might actually need to be factored into the broader kind of growth narrative and what that spells out for the economy too, and what we're going to be hearing from companies over reports over 2025.
Yeah, great question. That's clearly in the forefront, and the recent J-POW meeting is just more part of a strategy to recalibrate policy, really, rather than maintaining the restrictive stance on just consistent expected cuts. That Fed meeting brought the rate discussion right back into the forefront of the market conversations, and we were looking at a catalyst that would move the market in either direction, and clearly appears to be back. Like I said, we were lulled into this false sense of complacency that we were marching along to the Fed's target without any bumps along the way until Wednesday. Clear that inflation reduction has stalled, but their goal is still 2% at the end of the year, next year. So we have time. And quite honestly, what happened Wednesday probably sets up for a healthier 2025. As an investor, a little shocked to the system that there's more focus on looking at not only rewards but also some of the risks on the table.
Matt, always enjoy seeing your updates on the side here about your work in the basketball front as well here. Thanks so much for taking absolutely. Thank you so much for taking some time here. Hope you celebrated World Basketball Day over the weekend here as well here. Matt.
Always, yeah.
Great to see you. Thanks.
Yeah, good to see you too.
Now time for some of today's trending tickers here. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. First up, let's check in on WMT, Walmart. The Consumer Financial Protection Bureau is suing Walmart for forcing delivery drivers to use costly deposit accounts to get paid, as well as for deceiving workers about how they can access their earnings. The CFPB alleging that Walmart, as well as communication platform Branch Messenger, were opening branch accounts for its Spark delivery drivers and depositing the driver's pay into those accounts without their consent. Next up, Wedbush's Dan Ives out with a new note on Apple. Ives says iPhone 16 demand is slightly ahead of expectations globally and is set to have a strong holiday season. AI features as part of Apple Intelligence set to roll out over the next year in China and other countries. Ives expects Apple to hit $4 trillion in market cap by early 2025 and maintained the firm's outperform rating and $300 price target. And finally here, 2 new tickers this morning are trading as part of the S&P 500. You've got Apollo Global Management, parent company of Yahoo, and Workday. They joined the index before trading today, December 23rd. Every quarter, S&P Dow Jones Indices rebalances and includes the S&P 500. The 2 stocks will replace Qorvo and Amentum and will also move to the S&P Small Cap 600 index. Well, the IPO market showing a slightly more positive trend in 2024, and 2025 could see even more offerings. Yahoo Finance's Josh Lipton has been all across this one, clamoring for more deals to come forward, just as we all have been. Josh, here now with a look at what to expect in the year ahead.
That's right, Brad. So challenging, but resilient. That is how analysts describe the global capital markets environment this year. In 2024, the number of U.S. IPOs increased by more than 30%, with 176 offerings on U.S. exchanges. That's compared with 135 listings completed in 2023. It's according to the team over at Roth MKM. The total amount raised jumped nearly 1.5 times 2023 levels. So what did investors seem to prioritize? Well, analysts say it was really companies with strong fundamentals and a track record of profitable growth. So tech, media, telco, and consumer deals continue to lead the way in terms of the number of deals and the amount of funds raised. Notable listings, of course, including names like Waystar, Rubrik, and we have to mention Reddit, which has surged about 400% since its IPO back in March. So what about next year? What do the trends actually look like? Well, let's focus here on tech IPOs in particular, because we do hear debate on Yahoo Finance about that. And there are venture investors who do not expect a meaningful pickup in tech startups testing the public markets next year. Their point is that many of these private tech companies have raised a ton of money. And bottom line, they say they just don't need or want to be distracted by an IPO right now. They can afford, in other words, to stay private, focused on building and growing their businesses. Others disagree with that call, though. The market, they say, it's starved for IPOs now. And there is a pipeline of quality private companies now waiting in the wings.
there's the companies like Stripe and Databricks and SpaceX and OpenAI and, what I would call the granddaddy type companies who have plenty of access to capital, have raised a ton of money, have provided liquidity for shareholders and investors pretty consistently for a long time. Those are the haves. And then there's, and listen, there was, a strong private financing market kind of in the 2021 timeframe where some of these other companies raised a bunch of money, but there has been a dearth of liquidity. There is a need for liquidity for, the next level of companies, not with a real strong AI story. And I think the public markets are offering, really good multiples right now. And there's a lot of interest in these companies.
One name on Greg Martin's radar, by the way, the Swedish fintech firm Klarna, which filed registration documents with the SEC. Martin expects that company to raise $1 billion in an IPO early next year, Brad.
All right, this is certainly something we're going to be tracking going into next year. Near and dear to my heart after I used to work with the global listings division at Nasdaq.
That's
so
right.
We're going to be watching this close. Josh, thanks so much for breaking this down. Appreciate it. Coming up, everyone, we're touching on the 2025 economic trends that our next guest calls unstoppable. That's next.
For more than 6 decades, the discount megastore Walmart has redefined retail. In 2023 alone, the company brought in more than $648 billion in revenue. Beyond the Ticker takes a deep dive into the company's biggest moments. Walmart was founded in 1962 by Sam Walton. Its first location was in Rogers, Arkansas. 5 years later, the Walton family owned 24 stores and had racked up $12.7 million in sales. On October 1st, 1970, Walmart went public via an IPO on the New York Stock Exchange. Shares opened at $16.50 per share. The company opened its first Sam's Club in 1983 in Oklahoma in a bid to compete with Costco's wholesale member-only model. In early 1988, founder Sam Walton stepped down as CEO, and David Glass was named his successor. That same year, the first Walmart Supercenter opened in Washington, Missouri, creating what it's currently known for, that mix of general merchandise and grocery. In 1996, Walmart opened its first location in China and surpassed $1 billion in sales for the year. Walmart.com launched in 2000, allowing U.S. customers to shop online as Amazon.com began to take off. To compete with Amazon, among other online retailers, Walmart introduced free 2-day shipping in 2017. During the pandemic, the retailer boomed as consumers sought out the COVID-19 vaccine and meant cheaper groceries as inflation picked up. In late March, Walmart stock reached a record closing high of $61.45 per share, and it only keeps growing from here, with more than 10,500 stores in 19 different countries.
2025 is just days away. When it comes to the economy, our next guest says that there are 4 unstoppable trends to be on the lookout for. I want to bring in Stephen Whiting, who is the Citi Wealth Chief Investment Strategist and Chief Economist. Stephen, great to have you here with us. So walk us through these trends that you're watching.
Well, not all of these are positive at all times. Not all of these are long ideas in the stock market. But the things that we think of that are really shaping the world for the next decade include digitization. We've talked about this in the past with various increments of activity, everything from e-commerce to now, most importantly, artificial intelligence, as you see on the screen. Innovation on climate, we think, is very important for the future of the world. Longevity. This is a true unstoppable trend, aging and what it requires for us to invest in healthcare, and polarization. And what we're really talking about there is something that's maybe unfortunate, but is shaping, again, supply chains and a great deal of the types of very defensive activities we have to defend the world. This comes down to cybersecurity, for example. It comes down to tech supply chains and making sure that there is no really vulnerable supply chain in the world. So these are investments that we wouldn't necessarily do if the world is a perfect place, but it is what's necessary for the world we live in.
And so which of these trends that you're pointing out have the largest implications for portfolios?
Well, you could argue that there's more market cap associated with digitization. So if we just think about what's driving the largest U.S. tech companies, you could put 3 of them together and come up with more than $10 trillion in market cap. This is clearly AI and digitization. And that's been enough to drive 3 companies, not all of their business, but a big share of their gain in the last couple of years, to the point where these few companies are equal in size to either all of Europe or all of Asia in terms of shares.
All these things considered here, as you're thinking about some of the largest opportunities that are out there, even with these trends that you're anticipating, how does that create even more of either an acceleration of what has already kind of played out over the past year, and AI has been the large kind of runaway with the Fed towards the back half of the year kind of being sidelined in priority at least, but it seems like the Fed just tossed out some cold water that could have some larger implications even going into next year.
So there are many things that really are factors for the year ahead that are not part of the secular trend of the next decade. If we just talk about the Fed for a moment, we thought a few months ago that markets probably priced in too much easing. We are continuing to expect long-term rates to gradually climb over the course of the coming year. But we've now seen a pretty big move at the short end of the yield curve, and pricing 2 or less rate cuts by the Fed, we think, is actually a little bit more hawkish than we need to be. As we just heard from Fed Chair Powell, maybe the SEP is saying 2 more rate cuts, but it could well be a little bit more than that. And that's not going to arrest the bond market from having its challenges. And we do think that the inflation forecast that the Fed has shown, which is slightly above target in the coming year, these are relevant, as well as tariff and immigration policies. These are relevant, and these are not things that, again, are entirely secular trends over the coming decade.
You outlined 10 opportunistic positions as well here, and I'm not going to run through all 10, but I do want to highlight a few, especially as they've come up in conversation because of what has been prioritized by the incoming administration as well here, and where we could see some impacts on everything from biotechnology as that passes through to the broader healthcare landscape, some impacts in energy as well. That is, I think, 2 of the big opportunistic positions there. And then just lastly here, the geopolitical landscape too, with some of the Brazilian equities that you're even looking for. As you start to really rank those, and I didn't even mention deregulation because you've got US banks listed there too. As you start to really rank those, where should investors be pivoting their attention to?
Well, you asked earlier about these unstoppable trends and what really might be an issue for the coming year. And one of the things that we can say is that investors are putting a lot of confidence in the future of technology. That's in the price of these shares, whether or not they get the right ones or whether they've gone too far. There's just a lot of confidence and a higher valuation relative to the market and its own history for technology. Not so for healthcare. And we see that the healthcare sector is picking up EPS gains after a record drop for the industry. And so when you think about things like biotechnology or just simple medical devices and supplies, these are areas that have been indispensable for the economy and are not trading with a great deal of confidence at all. It's a lot of regulatory worry. That brings me to this other issue. When you think about banks or particular energy companies, these are deregulation beneficiaries. Whether it's going to be allowing industry mergers to take place, helping financials, to allowing more LNG exports. If you take a look at the applications for capacity increases in LNG exports over the coming 3 years, it's a doubling in export capacity, and there's demand for it in the world. And of course, there are other types of energy. We're not talking about just more crude oil. More crude oil, again, will probably lower the price. But deregulation in energy industries and globally is going to mean, again, more capacity additions for electricity. And that's critical, again, to that other unstoppable trend, AI.
A really fascinating outlook here. Stephen, would love to continue the conversation and check back in on some of these in the future and in the new year. Appreciate it.
Thank you.
Thanks. Uncertainty looming for some investors as we approach the new year, as we have a new administration coming in and future interest rate cuts in flux. How should investors be thinking about making major financial decisions going into 2025? For more, we're bringing in Michael Learsh, who is the head of advice and planning at Wells Fargo. Michael, always a pleasure to get some of your insights here. And so as you're thinking about setting financial goals in 2025, what is at the top of that list for investors?
Well, the top of the list, Brad, is really focusing on what you want to accomplish, but the big picture. And a lot of people are going, to your point, to tactics. What is the Fed going to do? How should I react to inflation in my spending patterns and in my financial life? I'd encourage everyone watching to take a bit of a step back, articulate your goals, whether that's a retirement goal or whether that's a goal to purchase a home, make a big purchase of another type, buy a car, whatever that is. Take a step back, really figure out the time period you want to buy that in, how you're going to buy it. Are you going to borrow money? Are you going to spend money from your own accounts? Are you going to divest investments to do so? And make that plan, because ultimately it's about time in the markets, time saving. It's not about market timing. And we need to remind ourselves of that, especially during, to your point, an extraordinary period of change.
When you talk about, and I love this point that you make as well in your notes as well, it's talking about intentionality specifically, because when you come to financial decisions, I mean, many of us kind of get into the analysis paralysis, right? So how do we then remove ourselves from that and kind of get out of that hole that we may have dug ourselves into by overthinking and then start to put tactics into action?
So there's a lot of fear that comes with change. And Brad, you know this, I'm a behavioral scientist, so this is the most fun and interesting thing that I love to talk about, which is how do you overcome that type of inertia? And you're making the exact right points. You have to be hyper intentional. So there's one version of fear, which is to stick your head in the sand and try to ignore everything that's out there. What I would encourage everyone to do is actually the exact opposite in 2025. Be extremely intentional. Watch your accounts. Watch how policies might change or shift or adapt, just like we saw with the Fed very recently in terms of some maybe of the changes they've made in terms of their perspectives. Be really on top of it, because ultimately what you want to do is position yourself to actually take action and reframe some of that fear into opportunity. Because when you become opportunistic, then you can achieve your financial goals faster, quicker, with better quality. And that is really what intentionality means, Brad.
With the psychology around it, I mean, it's really feeling like some of the therapy that we all need with our own finances right now. So let's just go further in that direction. As people are really looking to not just make their list, but also begin to cross things off, whether it be purchasing a home, whether it just be building up the nest egg for retirement, or even making sure that they have some type of fund for emergencies. Where are you seeing, at least in where you're discussing with clients and how the firm is engaging with clients, where are you seeing that prioritization right now? What's most chief from what you're hearing?
So when we look at how people are thinking and feeling moving into 2025, we really see that they're focused on, and you mentioned it yourself, some of those essential ideas in terms of the goals that they want to accomplish, discretionary or optional ones. They're willing to, really more closely evaluate in 25 and perhaps even delay some of those ideas. So what I would encourage everyone to do is follow along, really focus, to your point, whether it's making sure that you have that emergency cash in the background or even opportunistic cash to make an investment if it really presents itself as an opportunity to you. So that's where people are really prioritizing, is making sure that they are really focused on those essentials. And then when it comes to things like spending and how you allocate your resources, what we see is our clients want to focus on aligning that with their values. And that's what's really fascinating, Brad, about moving into 25, is this idea of value alignment, making sure I'm spending according to my intentions and how I view the value of my dollar. That's becoming really important. We see it in terms of people focusing on things like their community, really focusing on supporting local businesses. So it's an interesting trend to watch in 25.
Michael, thanks so much for taking the time. Happy holidays.
You too.
Coming up, everyone, we've got your Yahoo Finance market update. We'll check out how stocks are moving and run through 3 stories that you don't want to miss. Stay tuned.
We are 2 hours into the trading day. It is time for Yahoo Finance's market update. A mixed picture on Wall Street as investors kick off a shortened holiday trading week. The Dow down more than 200 points, while the Nasdaq is pointing higher. 3 trending headlines we are watching today. Shares of Eli Lilly up after its weight loss drug Zepbound received FDA approval to also treat sleep apnea in adults. Qualcomm shares getting a lift on a legal victory against ARM. The fight between partners stems from Qualcomm's acquisition of startup Nvidia in 2021. A Delaware judge ruled the U.S. chipmaker did not violate a licensing agreement when it integrated ARM's technology without paying a higher rate. And video streaming platform Rumble is on track for its best day in more than a year. The stock soaring on a $775 million investment from cryptocurrency firm Tether. That is your Yahoo Finance market update. For more on what's trending, scan the QR code below to track the worst and best performing stocks of the session with Yahoo Finance's trending tickers page. More wealth when we return.
Total U.S. household debt and credit card balances increased in the third quarter of 2024 by $147 billion and $24 billion, respectively. This is according to the New York Fed. And according to our next guest, 2025 could be the year of a credit hangover. Here with more on what might be ahead for consumer credit, we have VantageScore Chief Strategy Officer Ricard Bandibo. Great to have you here in studio with us.
Delighted to be here.
Certainly. So let's talk about this a little bit.
Sure.
Exactly what would a credit hangover look like if we see that play out?
Well, so, before I go into that, let's just understand the bigger picture. Obviously, as you've had many people tell you, that the economy as a whole is doing pretty well. And at VantageScore, we look a lot at consumer credit health, as we're a credit scoring company. And what we see is that the consumer, for most part, is actually going into 2025 pretty credit healthy. However, underneath that, there are some cracks, and what we're seeing is that there's going to be some particular segments of the consumer population that are going to struggle much more in 2025.
And so with that in mind, the hangover, as consumers are trying to navigate the spending that they do during the holiday season with the, oh my gosh moment of how much did we actually spend?
So what's been happening is that, since COVID, we saw originally a lot of consumers reduce their debt. But we're now at a point where we actually have the most amount of credit card debt in US history. So it's definitely come up quite a bit. The other thing that we're seeing as well is that the delinquency rates for credit cards have gone up about 50% over the past 2 years. So we're seeing that it's one of the fastest areas increasing in delinquencies. And we're expecting that trend to follow through into 2025. And that's being driven, as I said, by a few key things going on, both in terms of by certain types of consumer categories, but also in terms of what's happening with the K-shaped recovery.
So with that in mind, I wonder, because we just got data out from consumer confidence and the conference board here today, talking about U.S. consumer confidence pulling back in December. It seems like for multiple readings over the course of this year, we had continued to hear about a resilient consumer. But based on the data that you're laying out, and based on this most recent reading, there are clearly some cracks in the consumer, if not in the wallet and the spending propensity and ability, then in the mindset and the confidence going forward as well. What do you make of that?
So I think we're seeing a couple of things. One thing is, look, plenty of consumers, the reason why the amount of credit card debt is increasing is because prices are going up and they're being able to handle that. But underneath that, there is a growing number of consumers who are actually really struggling to make ends meet with the big increase in costs that they've had since COVID. And as a result, they're actually relying more and more on products like credit cards or personal loans or maybe even buy now, pay later as a way to subsidize their living. And the problem with that is it's digging them into a deeper credit hole.
Yeah. So with that in mind, as you think about the themes going into next year expected in the post-holiday credit hangover, how are you assessing those themes, and where, for some bright news in all of this, where consumers can best position themselves to tackle any of their debt that's related to the credit market right now?
So, I think, again, for the most part, most consumers are in a pretty good position. What we are seeing is that, obviously, if they start missing any payments, that can impact them on their credit score quite significantly. And when their credit score goes down, that means they may not be able to get the types of financial products that they want in the future, or they may have to pay a lot more to have them. So the first guidance is always just don't miss those payments. Do whatever you can to try to ensure that you're keeping your accounts up to date and on time.
Absolutely. Ricard, thanks so much for taking the time here with us today. Really appreciate the conversation. We're going to be checking back in just to make sure that we're not all totally hungover next year. Appreciate it.
Thank you.
Some key retirement-related changes are coming in 2025. Here to discuss a few of them, we've got Yahoo Finance senior columnist Kerry Hannon. Kerry, great to see you. Let's start with folks saving for retirement. How are contributions changing?
Yeah, hey, Brad, thanks. Yes, we're going to see some modest changes in 2025 for folks who have 401k plans or 403b, your employer provided plan. You can put up to $23,500 away in that 401k plan for 2025. And the great news is if you're 50 and older, you can throw in $7,500 on top of that. And the super saving icing coming in 2025 is if you're 60, 61, 62, 63, you can sock away an additional $11,250. So that's pretty sweet. For your IRAs, it's going to stay roughly the same, or exactly the same, I should say. So you're going to have $7,000 you can put into an IRA in 2025 and a $1,000 catch up if you're 50 or older.
And so,
the good news for all of us who love Roth IRAs is that the income limit is shifting upwards, so that you're eligible now at it's going to $150,000 to $165,000. So that bumps up. That will allow more people to participate in these Roth IRAs. Again, that's a really promising thing. And the other savings account that a lot of people overlook when they consider their retirement accounts is the health savings account. And Brad, this is so wonderful because it has this triple tax advantage. You're not taxed on the money you put into it. The money that grows inside of it, your investment, does not get taxed. And it's not taxed when it comes out for qualified medical expenses. So this is a wonderful thing. And that is bumped up again modestly, but it'll be $4,300 in 2025 for an individual and $8,550 for family coverage. So I'm a big fan of those, and anyone who can use those for retirement savings, it's a wonderful vehicle.
And so, Carrie, for those who are already retired, what changes are coming to Social Security and Medicare?
Yeah, this is a kind of a good and bad situation. We've got the cost of living increase, the COLA, which will come into hit retirees' Social Security checks in January. That's bumping up 2.5% for 2025 from this year to meet inflation, right? So that's really great. I mean, it'll be an additional, again, it's modest, but maybe for the average Social Security check of $1,900, this will be about a $50 increase in the monthly check. But here comes Medicare. The Medicare Part B premiums have also ticked up. And so that's going to eat away a little bit of that uptick we saw in the cost of living adjustment, right? So they're going to go up, the Medicare premium, around $10.30 a month. And the deductibles are also going to go up. So the deductible is going to go up by about $17. So you lose a little of the uptick of the cost of living adjustment. You still have a bump up. But again, there are two things that are happening there for Social Security and Medicare in 2025.
All right, really timely breakdown of some of those changes coming once we flip to the new year. Carrie, thanks so much. Appreciate it.
Thank you, Brad.
Let's get a check of the markets here as we are just a little over 2 hours into trading on the day. The S&P 500, you're seeing that just barely to the upside right now by about 0.1% during today's session. The Nasdaq Composite Tech Heavy Average, you're seeing that lead in terms of the percentage gains here on the day. That's up by about 0.5%. The Dow Jones Industrial Average, it's been trying to make up its mind over the course of today. As of right now, though, you are seeing that down by about 0.3%. It is in the red here, has been for much of the session. And then also taking a look at some of the heat maps. Who doesn't love a good map? We've got it just with a little bit of red and green here, Christmas themed, if you will. But anyway, as we're taking a look at some of the Dow Jones Industrials here, let's just put this on an equal so you can get a good flat look at how things are trending here on the day. Clearly, more laggards than gainers here. Walmart bringing up the caboose during today's activity. That's down by about 3% right now. But Nvidia, that is leading the pack. That's up by about 2% during today's trading session. Also want to take a look at the 11 S&P 500 sectors here. 2 hours into the trading day, we're about as split as you can get here, but it does look like we've actually got more laggards than leaders as of right now. As we're taking a look at 4 leaders, which of most technology, that's leading the pack. That's up by about 0.5%. Bringing up the caboose, though, you've got Staples. That is down by about 1.4%. And then just lastly, I'll take a quick look at some of the cryptocurrencies. Right now, you're watching Bitcoin, which is below 100,000. And right now, it's been continuing to slip over the course of today's activity. Of course, this is a market that does not close, and you're taking a look at Bitcoin right now below 93,000. So about a $10,000 plus pullback from some of the highs that we've seen in recent days as well. We'll just put this in context for you over the past 10 days. And of course, this was that new high that we had seen come in here. I don't have my little handy dandy pen or highlighter feature. So we'll ultimately come back to that just a little bit later on, but you get the picture with the chart. Well, haven't gotten your holiday gifts yet? Well, I've got a gift idea for you here. Giving the gift of stocks. Here to break it down, we've got Erica Safran, who is the certified financial planner at Safran Wealth Advisors. Erica, great to have you here with us in studio. So take me through the basics of gifting stock. How does it work?
Well, the easiest way to give stock is to transfer securities from your account into the account of the person you want to give it to. And hello there.
Hey.
So that was the first part. Yes. That's the easy part. But then you want to think, well, does that other person have an account? If they don't have an account, it'd be really wise if they set up a brokerage account somewhere. And the ideal way would be for them to have a brokerage account the same place you do. That would make transferring easy.
Certainly.
So transferring stocks is so much easier today than it was maybe decades ago when someone would buy a certificate and then give a certificate, and then you'd have to take that certificate and deposit it at a brokerage firm. So today it's really streamlined and simple.
Is it free?
Great question. Transferring securities at a brokerage firm to any entity is free.
Okay.
I can transfer to you or anyone I want.
Please, by all means.
I'm on it. Wait, where's your firm? But then there are some online investment firms that only operate online. I don't want to give names, but they typically charge 100, 200, sizable amounts to transfer assets. So ask the question before you transfer securities. Don't be blindsided.
So what are some of the tax implications of gifting stock?
That's a beautiful thing. There is no tax implication in giving, and there's no there's no income tax implication in giving. So I can give a gift of $1 million securities, million value in securities, no income tax to me. And the person can receive that gift, no income tax to them. And everywhere the concept is an $18,000 gift tax exclusion. So if you give amounts over that, it's a taxable gift. Well, the fact is that that is a issue that doesn't affect us during life. So for example, I could give $18,000 to every person in this world, run out of money, and then have zero income tax.
A lot of people would love you for it.
Without question, and have zero income tax implication.
Interesting.
Okay. And then why is it an issue then? Why is everyone talking about it if it doesn't impact me, it doesn't impact the person receiving the money? Where it has an impact is that any gift that you make that's over $18,000 has to be reported on your tax return.
Okay.
You go, why? Why does the IRS care? I give $20,000, I'm going to report $2,000 is that I gave a gift.
Sure.
The only time this matters is when you die. Because that $2,000 that's above the $18,000 gift tax limit, that goes added back into your estate. But honestly, unless you have more than $13.6 million in your estate, you shouldn't really care.
Certainly. So is it better to give cash versus stock? How do you go about really analyzing and going through the mathematics, the calculus of which you should be giving?
I bought a stock that I paid $10 for. It's now worth $50. So my $10,000 is now $50,000. I want to give you the cash because I really like you and I care about you. So I'm going to sell my stock. I have $40,000 in gains. I'm going to pay capital gains tax and state tax on it, and probably give away a quarter of it at least.
Yeah.
So instead of 50, now I have whatever, 35, 40. So let's not do that. The best thing to do is to gift securities that have the lowest cost basis. So if I bought it for 10 and it's now 50 and I give it to you, it's as if you had bought the security in the first place.
Yeah.
So you're inheriting that cost basis.
Yeah.
Now, mind you, I'm giving it all to you. I move that appreciated stock out of my estate. I don't have to pay taxes on it to give it to you, and you receive that money tax-free.
All right.
Now, you or the recipient doesn't pay income tax on receiving it, but when they do sell it, they will pay taxes on that gain as if they had bought the stock to start with.
Interesting.
Does that make sense that
Absolutely.
I explain it? So
No,
you inherit my cost
well.
basis.
Yeah. I don't want to do that.
Well, actually, it's not that you don't want to do that. You just want to hold on to it.
Sure, right.
Because if it grows enough, it's really okay to pay taxes on gains because you've done your job well. You've
As long
made
as the
money.
gains exceed what you would have to pay in the tax on it.
Without question.
For sure.
It's always a small percentage point.
Really great breakdown on all of this and gifting. It perhaps gives folks some new ideas out there about how to gift stock. Erica Saffron, thanks so much for taking the time.
My pleasure.
Coming up, everyone, we're taking a deeper dive into health insurance claims. That's next when Wealth returns. A programming note. In this week's episode of Decoding Retirement, host Bob Powell speaks to the head of TIAA Institute and a retirement strategist about preparing for long-term care, the younger generation's retirement outlook, and much, much more.
When Gen Z view retirement and the path they will take to get there, there is a breaking of financial norms from other generations. The word freedom came through a lot in the study, and they do not see their professional life stopping at age 62. And they also don't think they'll be working for the same company for their entire career.
New episodes of Decoding Retirement air Tuesday at 12 p.m. Eastern Time. You can catch them on Yahoo Finance or wherever you get your podcasts. We're taking a deeper look into health insurance claims, this coming against the backdrop of increasing pushback against the insurance industry from denied claims. For more, we're bringing in Yahoo Finance senior health reporter Anjali Kemlani. Hey, Anj.
Hey, Brad. We know this is a sensitive topic, and claim denials are basically how doctors and hospitals get reimbursed for their services. When insurance plans deny them with pre-authorization requests, they essentially delay care until the doctor can get the procedure or treatment authorized. And if a claim is denied after the fact, that's usually creating a huge financial burden for these patients. So it's not clear why, and this issue ties back to the recent killing of a United Healthcare executive, and it's unclear what the target of this killer was, but it has really unleashed the anger of the American public, which is just frustrated with the way that these companies are doing business. And so what we're learning is that we don't actually know how widespread and how prevalent the denial of claims is, but we do have some anecdotal evidence. United Healthcare has the highest denial rate based on Medicare data at 32%, while the insurance industry average is about 17% based on this data. Looking across your screen, you can see some of the other players as well. Meanwhile, United Health Group said that it only denies about 10% of claims based on its own numbers. So you can see just quite a discrepancy there. Meanwhile, looking at another niche area for anecdotes, Komodo Health just came out with another study for prescription drugs, saying that denials have been somewhat flat at about 15% between 2016 and 2024. Then take another look at another survey now with KFF saying that the type of insurance plan can determine the likelihood of the claims. And so fully insured plans, for example, will have, like a Medicare Advantage, ACA Marketplace, those will have higher denial rates than a self-funded employer plan. And that's because the insurance company is charged with spending the premium dollars in those cases, so they're incentivized to spend less. In a self-funded plan, employers are taking control of the purse strings because they want to keep employees happy and have as little friction as possible. So experts have told me that that's why they're more lenient. Now, of course, understandably, when you're part of that 10 or 15%, you feel like it's 100, so we hear about these denials so often. And the reason why this dynamic exists is because insurers see themselves as gatekeepers. So they're looking for ways to pluck out fraud, waste, or abuse in the system. And doctors who may want to charge higher for procedures and choose options that are not cheaper when there are options that are available. So that's what they see themselves as. And this system is what has created this dynamic. And it started at a time when fax machines and hefty loads of paperwork were used. But now the problem is that with automation, insurers are relying more on artificial intelligence and technology that has been fed certain parameters in order to process claims that are resulting in this denial, this anecdotal, increase in denial of claims. So this is what is creating the tension. This is why we've seen, the population so angry. And so while there is no real solution around the corner, there's no way around this. I've spoken to some experts, and over the years, I've kind of perfected these top 3 tips. The first being never, ever, ever pay the first bill. And insiders will tell you never. Always fight with the insurance company for coverage, and try asking for cash pay options. When you're at the hospital and you're being told this is what your out-of-pocket is, sometimes the cash pay option is going to be cheaper for you.
Anjali, great breakdown there and some key tips. Everybody screenshot that over at home. Appreciate it, Anj. That's it for Wealth, everyone. I'm Brad Smith. Thank you for watching. You can stay tuned for Market Domination. That comes up at 3 p.m. Eastern Time. They'll count you down to and through the market close.